Good. All right. Okay. The committee will come to order. Without objection, the chair is authorized to declare a recess of the committee at any time. This hearing is entitled the FHFA Oversight, Protecting Homeowners and Taxpayers. Without objection, all members will have 5 legislative days within which to submit extraneous materials to the chair for inclusion in the record. I now recognize myself for a 4-minute opening statement. This morning, the committee will hold a hearing called Federal Housing Finance Agency Oversight, Protecting Homeowners and Taxpayers. This is our committee's second hearing on the government's role and response to the housing challenges faced by too many Americans in as many weeks. We're fortunate today to have the FHFA Director, Sandra Thompson, as our witness for the second time in her 2 years as head of the agency. Director Thompson has had a long career with over 20 years' experience with the Federal Deposit Insurance Corporation, followed by 10 years at FHFA. Thank you for being here, Director. Let's address the elephant in the room. Fannie Mae and Freddie Mac have been under government conservatorship for nearly 15 years. And to echo former Acting Director Ed DeMarco last week, we're asking a lot of our FHFA Director to act as both a regulator and conservator for Fannie Mae and Freddie Mac, and continue to make what would otherwise be private business decisions while also regulating the enterprises. As long as the GSEs are under conservatorship, the agency's primary focus should be raising enterprise capital and maintaining their narrow charter and mission. In many respects, housing finance in this country looks dramatically different than it did back when the agency was created in 2008. According to recent research, non-bank companies now originate 71% of agency-backed loans and 86% of government-backed loans. Banks have all but retreated from the servicing and loan origination business because of bank capital and liquidity rules implemented in the Dodd-Frank regime. Meanwhile, back in 2008, the Fed started buying mortgage-backed securities for the first time as a temporary response to the financial crisis. But now they own nearly a quarter, 25% of all 1 to 4 family residential mortgages in the country. And the Fed has only recently started trimming its $2.7 trillion in mortgage-backed securities. Generationally high inflation and out-of-control government spending have made housing affordability worse, with mortgage rates now hitting 20-year highs last fall, and the GSEs somehow become even larger. We have to realize that these outcomes are the result of actions taken in this very room over many years. And it's hard for me to see this as a good outcome. Having lived through the Obama, Trump, and Biden administrations, no serious collaborative reform to the GSEs. Enter the FHFA, which has tremendous influence over our housing market and the American economy. Director Thompson's been active on a host of initiatives to revamp and expand the roles that Fannie and Freddie play. These include the questionable, politically driven, equitable housing finance plan lending mandates, to the technical, like improving the process for new product approval and continuing to build enterprise capital. Members can decide for themselves if these changes are good or bad, but it's clear if you favor a more limited scope for government's role in housing, as I do, you're probably out of luck. And as we've been trending in the wrong direction for over a decade. All that brings this hearing and the critical need for Congress to do its job and provide oversight and accountability to FHFA. In too many instances, it appears that the agency has allowed safety and soundness to take a back seat to advancing a housing agenda through the GSEs. We saw earlier this month when the agency rescinded its unworkable debt-to-income-based fee and issued a request for input on the opaque process it used to set GSE pricing adjustments. The agency also has to be focused on the safety and soundness not only of Fannie and Freddie, but the 11 federal home loan banks, and given what's happened in the banking market, that's a critical issue. I'll now turn to the ranking member for a 4-minute opening statement.
Thank you very much. Good morning, all. I'm pleased to welcome Director Sandra L. Thompson before our committee this morning. Earlier this month, the Federal Housing Finance Agency took a step in the right direction to adjust loan level price adjustments, or LLPAs, in a way that ensures lower-income borrowers with great credit scores, but not enough for a 20% down payment, particularly in today's housing market, are not unfairly penalized compared to similar borrowers with higher income and higher wealth. Unfortunately, Republicans are continuing to spread misinformation about the new pricing framework and regurgitating alternative facts about what this actually means for borrowers, even after their own witness debunked their claims last week. Well, here are the facts yet again. These changes will not result in higher credit score borrowers subsidizing lower credit score borrowers. As former FHFA Director Ed DeMarco, who was invited by the Republicans to a hearing last week, stated, these price changes, quote, are not focused on cross-subsidization. They are focused on making sure across the grid that we're making a rate of return efficient for the capital that has to be raised, unquote. In fact, these changes follow through on capital rules enacted by the Trump administration. More importantly, as our nation's housing and homelessness crisis worsen across rural and urban communities, FHFA's changes will correct for unfair subsidies that have benefited wealthier individuals purchasing lavish vacation homes and investment properties for over a decade. I'd also like to point out that Director Thompson's updates to the pricing framework will benefit constituents everywhere, including in Chair McHenry's district in North Carolina and Subcommittee Chair Davidson's district in Ohio, where home buyers will pay some of the lowest fees among all enterprise borrowers. My colleagues on the other side of the aisle appear to be more concerned about protecting the wealthy, even if it comes at the expense of those with less intergenerational wealth. I, for one, support FHFA's effort to expand across to the American dream of home ownership for every credit-worthy borrower on fair terms. Finally, I'd like to close with this. Despite supporting a debt ceiling increase 3 times under Trump, and despite President Biden making a generous offer of level funding the government next year, Republicans continue to threaten economic calamity, including chaos in the housing market that would raise market rates to well over 8%. Their plan also eliminate 100,000 jobs for teachers, put millions at risk of homelessness, and undermine health insurance for 21 million Americans. The fact that Republicans are up in arms about FHFA's modest pricing adjustments that their own Republican witness supports, while ignoring the devastating cost and harm of debt ceiling brinksmanship, shows everyone what they really care about, undermining Biden by undermining America. Committee and House Democrats will continue to support policies that help every family live affordably and with dignity, both through housing reforms and cleanly raising the debt ceiling. So I look forward to Director Thompson setting the record straight today. And with that, I yield back.
Gentleman yields back. The chair recognizes Mr. Davidson, the chairman of the Subcommittee on Housing and Insurance, for 1 minute.
Director Thompson, thank you for joining us today. This hearing comes at a critical time as consumers are struggling with inflation, much of which can be attributed to high housing costs. The Federal Housing Finance Agency may not be the most well-known agency for average Americans, but your credit score redistribution plan has captured everyone's attention. In response to our letter and market feedback, I am pleased that you have withdrawn a portion of your LLPA changes related to debt-to-income ratios. Thank you for that. Nevertheless, I'm confident you will hear that additional work remains to be done. As both regulator and conservator, I'll remind you that the conservatorship for Fannie and Freddie has lasted longer than Britney Spears' conservatorship did. Between that, the credit score redistribution plan bypassing traditional title insurance, limiting consumer credit information, and federal home loan bank oversight, there is much concern about FHFA's current focus. I'm sure these will all be discussed today, and I look forward to hearing your answers.
Gentleman from Missouri, Mr. Cleaver, the ranking member of the Housing Subcommittee, is recognized for 1 minute.
Thank you, Mr. Chairman. Thank you, Madam Chair, for being here with us today. Housing is roughly 15% of the gross domestic product, 30% of inflation, and the largest source of wealth among American families. According to the Federal Reserve, the wealth of a homeowner is 40 times greater than that of a renter. Addressing the lack of housing supply and preserving the opportunity for homeownership for the average American requires deliberate and sustained action. Unfortunately, some of my colleagues in Congress have abandoned what I believe to be a very significant issue as it relates to housing. And we have not done very much discussion or action on housing since January. Amid a lack of action in Congress, the FHFA has taken great strides in safety, soundness, and support for aspiring homeowners. I look forward to hearing from Director Thompson this morning, and thank you again for this hearing.
Gentleman yields back. Today, we welcome the testimony of the Honorable Sandra L. Thompson, Director of the Federal Housing Finance Agency. Director Thompson, we thank you for taking time to be with us again. Once again, before the committee, you'll be recognized for 5 minutes to give an oral presentation of your testimony. Without objection, your written statement will be made a part of the full record. Director Thompson, you're now recognized for 5 minutes.
Thank you. Chairman McHenry in his absence, Ranking Member Waters and Mr. Hill, and distinguished members of the committee, I am pleased to be with you today to discuss FHFA's work and the country's challenges facing our housing market. When I last appeared before this committee in July, I spoke about my career as a federal safety and soundness regulator. The safety and soundness of our regulated entities is a key component of all policy decisions.
Would you pause for just a minute? Could you pull the mic a little closer to you? We're having a few people have a hard, the thing will extend up closer to you. Yep, thanks so much. Thank you very much. I thank the director.
When I appeared before this committee in July, I spoke about my career as a federal safety and soundness regulator. The safety and soundness of our regulated entities is a key component of all policy decisions and other actions we take. The enterprises and the home loan bank system cannot achieve their missions without a continued and unwavering focus on safety and soundness. As you know, home prices have soared in recent years, and mortgage interest rates are higher than they've been since the record low interest rates experienced during the pandemic. In addition, the country is dealing with a housing supply shortage. There simply are not enough houses, especially for first-time home buyers. Many young adults, people just starting out, college graduates, people who've been renting for a while, along with members of our workforce whose professions require them to live where they work, such as teachers, policemen, firefighters, and other first responders, just can't afford home ownership. Or if they can buy a home, they have to move far away from their places of employment to find a home they can afford. This is true for people across our country in both rural and urban areas. Most first-time home buyers cannot afford to put 20% down on a house. That's $40,000 on a $200,000 house and $60,000 on a $300,000 house. These are credit-worthy people who are paying their rent, utility, and other bills on time. They simply cannot afford a large down payment. The pricing changes we've made will help most first-time home buyers by eliminating the upfront fees. We were able to do this because the returns the enterprises earn on second homes and vacation homes, investor homes, are more than enough to offset the first-time home buyer upfront fee. But unfortunately, the reality is that even with no upfront fees, the first-time home buyer still pays higher overall mortgage costs than most other home buyers. Pricing for loans is complex, so I'd like to take this opportunity to provide more context and clarity so the public can better understand why we made changes to the outdated pricing grids. FHFA updated the pricing framework for 3 reasons. 1, to update grids that had not been changed in almost a decade. 2, to help creditworthy first-time homebuyers limited by income and wealth across this country, and 3, to enhance the safety and soundness of the enterprises by building capital. This reduces the risk to taxpayers who have borne the burden of supporting the enterprises since they were placed into conservatorship in 2008. The pricing grids in effect prior to these changes had not been updated in many years and were not fully reflective of the capital framework that governed the enterprise's requirements. In fact, the prior grids, many low to moderate income borrowers were overcharged and some borrowers were undercharged compared to the capital requirements. But most importantly, and I want to be very clear on this key point, which is one that bears repeating, in the new pricing grids, borrowers with strong credit profiles are not being penalized at the expense of borrowers with weaker credit profiles. Put another way, even with reduced fees, borrowers with lower credit scores and lower down payments will continue to pay higher overall mortgage costs than borrowers with higher credit scores and higher down payments. The purchase of a home is a complicated transaction, and home buyers should have accurate information to make the best decisions possible. Understanding how mortgage insurance is factored into pricing is critical to the fee calculation. By law, the enterprises cannot purchase a loan with a loan-to-value greater than 80%, which means that if someone puts down more than 20% or more, or less, 20% or less, they have to have credit enhancement to protect the enterprises. Most of the time, this credit enhancement takes the form of mortgage insurance. Borrowers must pay for this insurance in addition to their guarantee fees. This does not show up on the pricing grids and is why many loans with loan-to-value ratios greater than 80% have what looks like lower fees, but you have to add the mortgage insurance premium to these loans to get a more complete picture of borrower costs. The less down payment you have, the more mortgage insurance coverage you need, and the higher the cost. The recent focus on pricing brings needed attention to our housing affordability challenges. Housing makes up almost 16% of U.S. GDP, and for most Americans, their home is their largest asset. Owning a home is the primary way for hardworking families to build wealth and pass it on to their children and grandchildren. And for renters, their rent bill is usually the largest expense that they have every month. Every American deserves safe, decent, and affordable housing. And I would love to work with this committee to come up with ways to address the increasingly unattainable American dream of owning a home. I'm sure if we work together, we can find other ways to make housing more affordable so that people who have had their dreams deferred or denied can one day soon be in a home of their own so they can start the wealth-building journey that will benefit not only their families, but also their communities.
Thank you, Director, for your testimony. It's now time to turn to members' questions. I recognize myself for 5 minutes for questioning. The agency has a new activities rule, which you worked on mightily when you were first in office, which means there's transparency around any new products and activities by the government-sponsored enterprises so that they don't displace private sector firms or crowd out capital. For this reason, I was glad to see the rulemaking finalized in December. Under this process, they now have to submit advance notice and get approval for new products and activities, including any pilot programs. Director Thompson, since the rules have gone into effect, have you received any submitted submissions for new activities or products?
Thank you, Mr. Hill. The new activities rule, as you mentioned, was finalized last year, and we spent this year implementing processes for FHFA and the enterprises to submit and for us to review. We deferred the implementation through April 28th, and we told the enterprises if they had new products, they would have to wait until our processes were complete before they submit to the agency for our review.
So are those now processes complete and they're now open to submission?
Yes, the processes are complete, and we have not yet received from my perspective, because they have to come through our new products committee, which actually we're having a meeting tomorrow on some of the products that are coming.
Would you commit to notifying Congress if and when the agency makes any decisions on any of those future submissions?
So we're happy to work with the Congress. But I would mention, as part of the rule, we have a pilot transparency page so that any pilot that the enterprises are undertaking is posted on our website. But we're absolutely happy to work with the committee.
I think that would be helpful. Thank you. Since you've been in your position over the last 2 years, is the capital ratios, the capital requirements for Fannie Mae and Freddie Mac, is capital higher or lower in the enterprises than it was when you became director?
So great question. The enterprises capital rule was put into.
But I mean, the capital itself, or the,
The actual capital, yes.
yeah, actual capital for Fannie Mae and Freddie Mac, is it
the
higher or
enterprise-
lower than when you came into office?
Well, it's higher than it was when I came into office. The
And is-
enterprises are just now able to retain capital.
And is the rule, the capital mandate, is it require more capital now, or was it higher when you took office? The rule itself,
The rule-
requirement.
The rule was changed to allow for credit risk transfer, which, as you know, both enterprises are the biggest holders of mortgage credit in the country. And we facilitated a credit risk transfer process by making nominal changes to the capital rule. When I came in to serve as acting director, the rule was penalizing to some extent the credit risk transfer, which moves the enterprise's credit risk to the private sector. We made changes not to the requirements themselves, but to the leverage buffer. We took, instead of having a static buffer, we made it more dynamic and facilitated more credit risk transfer because the leverage ratio, as
Thank
you
you.
know, Mr. Hill, would
That's
have been
helpful.
binding.
Are you concerned about, with high interest rates and high inflation, are you concerned about the impact of inflation and high interest rates on the health of the agencies? And if so, do you think their capital requirements should be higher right now?
I'm very concerned about the health of our country as it relates to inflation.
No, I'm talking about the GSEs,
The
not the
GS
country at large.
The GSEs, absolutely. We are very much trying to build capital so that they can continue to operate in a safe and sound manner. I don't believe that they need more capital. They right now need about $300 billion between the two of them, and that's quite a lot of capital
Yeah.
that's required
Thank
based
you.
on the capital requirements.
And with the remaining time I have, I want to switch subjects, and I encourage my colleagues on both sides of the aisle to ask questions on the subject of your oversight of the federal home loan banks. We've had just a colossal use of the federal home loan banks in this last 5 months due to the crisis in the banking industry for liquidity. Is it still your intent to provide administrative and legislative recommendations on the oversight of the federal home loan banks? And if so, when are you going to do that?
Yes, Mr. Hill, we are undergoing a study of the home loan banks, and the report should be published in the third quarter of this year.
You think by September 30th or early in the third quarter?
Well, we're working as quickly as we can. I'll just give the September 30th deadline.
Thank you. And I yield back, and I now call on the ranking member for 5 minutes of questions.
Thank you very much. I'm going to continue with my questions based on where you started dealing with the question of inflation. Director Thompson, I'm concerned about adjustable rate mortgages, or ARMs, which have interest rates that change over the life of the mortgage. This was a major issue in the aftermath of the 2008 financial crisis, when ARMs contributed to countless households losing their homes. I know that we made reforms to prevent some of the most predatory features of the kind of ARMs that were problematic back then, but I remain concerned that some people are still choosing these products without fully being aware of the risks they're taking, unless a homeowner knows how to refinance their mortgage into a fixed rate loan and can afford to do so. They may see their monthly housing payment increase significantly. This is especially true in high-cost markets. I've heard from constituents in my district who are ARMs and have seen their monthly payments increase by $1,000 a month, which is a financial shock for their families. And so I wanted to talk about, educating consumers about ARMs and how they're different from 2008, and what does the volume of ARMs purchased by Fannie Mae and Freddie Mae look like today. But what I really want to explore is the fact that with inflation and with the feds increasing the interest rates in order to contain inflation, it's causing these ARMs to be in a position where they're going to lose these homes. Is there anything that can be done to say to the mortgage holders or the banks, you don't have to continue to do this? You may do it because you have this kind of an arms agreement, but can we say you got to stop at some point?
Thank you for the question, Ranking Member Waters. I am very concerned about ARMs as well, but I'm also happy to say that most of the mortgages that the enterprises, Fannie and Freddie, purchase are fixed rate. Many people took advantage of the low interest rate environment in 2020 and 21 to refinance their homes. And so the majority of the loans that the enterprises own right now have very low interest rates. But I do get concerned because of the higher interest rate environment. Many times the ARM offers a lower starter interest rate, but the nice thing about some of the changes that have been made since the Great Recession was that now underwriters have to underwrite to the fully amortized index of the loan. So instead of underwriting, can you make this payment at 2% or 3%, they have to, add the margin and underwrite to the full payment of the loan so that borrowers are fully protected. And so I do think that the rising interest rate environment contributes greatly to the purchase activity at both enterprises, because we've just changed from seeing record refinances at those low interest rates to very high interest rates in a very short period of time. And so I do think that the underwriting provisions that are in place for mortgages, at least the ones that Fannie and Freddie buy, are well suited to assess the borrower's ability to repay.
I think I want to talk with you about that some more. Okay. Director Thompson, let me just go into another question here. Let's see. We are less than 2 weeks away from defaulting on our nation's debt, and my Republican colleagues are threatening a completely avoidable economic catastrophe that would have global impacts. If we were to default on our national debt, the impacts on our housing market and on prospective home buyers would be devastating. It has been reported that mortgage rates could rise by 8%. By comparison, the changes you made to LLPAs would have a very modest effect on mortgage prices for the average home buyer. Director Thompson, could you help us put your changes to the pricing framework in context? What could we expect to happen in the mortgage market and to the cost of a mortgage if we default on our nation's debt?
So thank you for the question. I think mortgage interest rates will increase substantially. It'll be even more difficult for borrowers or potential borrowers to enter into home ownership. There would be concern amongst the investor community because there are a number of investors
Thank you,
around the
Director.
world.
I thank the ranking member. The gentleman from Texas, Mr. Sessions, is now recognized for 5 minutes.
Mr. Chairman, thank you very much. Director, I'm delighted that you're here. I began receiving letters as early as January, February, and March. And while I have not provided you a copy of the letter, which I will be pleased to do, people who are in appraisal services and in housing across the 17th District of Texas have written me. Essentially, it's not just a concern about conservatorship, but it is specifically about that conversation that Fannie Mae, and I'm quoting from a letter, Fannie Mae has grossly overstepped its authority during its conservatorship by moving to abolish appraisals for purpose and refinance purposes in its new Fannie Mae selling guidelines published on March the 1st. Can you please discuss with this committee the effect of that and your thinking about that?
Sure. Well, first, let me say that appraisals are always an option, and there are alternatives to appraisals, which we discovered during the pandemic when we had the record number of refinances, and people wouldn't let you in their homes for an appraisal, and nobody wanted to go to do these appraisals. So we have what's called desktop underwriting, which is, it allows an appraiser to input information about a property into a desktop system. And we also have what you're talking about, appraisal waivers, but those are primarily for, very low risk loans and primarily used in refinances where the borrower has lots of equity and they have to reach certain criteria. It is not the goal of Fannie Mae or Freddie Mac to ever serve in any primary market capacity. Fannie and Freddie have come up with alternative tools to help the borrower and the lenders move the loan along in the process. And I think that we have leveraged technology, which also helps with safety and soundness because it provides good risk management oversight on the whole mortgage process.
So your testimony today is essentially this was used only in refinancing?
Refinancing and limited purchase properties. It has to be very specific circumstances. But we are not trying to eliminate or abolish appraisals. And a borrower always has the right to have an appraisal, a full appraisal.
Okay. I would like to, as you have stated in this committee, offer my concern over this conservatorship. And I think that it's important to note that this committee that Mr. Davidson has outlined really wants to know more about the ending of that conservatorship. Could you take a minute and please discuss that?
Sure. So again, the enterprises have been in conservatorship for 15 years. They first have to meet their capital requirements, which I mentioned earlier, about $300 billion between the two of them. In addition, this isn't a decision that FHFA alone would have to undertake. As you know, there's a huge ownership interest that the Treasury has in Fannie and Freddie, and that's been long-standing. So we'd have to have conversations with them. And we'd also have to figure out what the impacts and implications are for the enterprises outside of conservatorship. There are lots of rules that would be impacted. For example, the single counterparty rule that the Federal Reserve has. If Fannie and Freddie are out of conservatorship, what does that mean? Right now we have a uniform mortgage-backed securities. Do Fannie and Freddie securities count towards that single counterparty rule? There are risk transfer rules that have to be looked at. So there are a number of rules that relate to capital markets activities that would have to be considered as well. But the main point is that the enterprises have to meet their capital requirements, and those are minimum capital requirements.
And you believe that that's the linchpin about why this has not moved forward?
Well, I think as was stated earlier, that's one component, but the enterprises have been in conservatorship for 15 years, and there's been lots of conversation, proposed legislation and the like on what to do with Fannie and Freddie, and that is a decision for the Congress to make.
Thank you very much. It's obviously clearly within our purview also, and I appreciate the time. Mr. Chairman, I yield back.
I thank the gentleman from California. Mr. Sherman is now recognized for 5 minutes.
Those who do not remember history are doomed to repeat it. Many of us in this room experienced the meltdown of the GSEs during the 2008 Great Recession. That occurred in large part because you had enterprises that were out to make a profit, so they participated in the upside when things were good, and there was an implicit, turned out to be explicit, federal guarantee. So the taxpayers took the risk, the private shareholders took the upside, and of course, because they got the upside and didn't have the downside, the shareholders insisted upon excessively risky policies. Now there are those who say, let's free Fannie and Freddie from the conservatorship and return to what we had in 2007. I'd say if it's not broke, don't fix it. These agencies are doing a great job of helping homeowners who are borrowing at just a bit over what the U.S. government borrows at, and they're making money for the federal government. So I realize conservatorship may not have worked well for Britney Spears, but it's working out very well for us. We're told that inflation hurts home buyers, and it does, and that somehow the decisions made in this building caused that inflation. That is a remarkable conclusion, since inflation has, over the last year, been higher in Germany or the UK or France than it is here. And the COVID is worldwide. The policies made here in this capital are not. I was going to ask that great question that the ranking member asked about the effect of a debt default on home buyers. It would be disastrous, as you pointed out. You've talked about the high cost of housing and the low supply. Our friends making state and local government decisions have caved into NIMBYs again and again, especially when it comes to apartments and condos. We need more housing, and we need to build it somewhere. Director Thompson, Representative Lukemeyer and I sent you a letter expressing concerns about the GSEs, saying that you don't need title insurance, you just get an opinion letter from a lawyer. I wrote a lot of lawyers' letters. When I was a lawyer, none of them came with a guarantee. For if somebody buys a home and it turns out what they bought, they don't own it, and all they have is an opinion letter, first, they have to prove that the attorney was negligent. And this is complicated stuff. I made a lot of mistakes back in my day that were not my fault. Also made some that were my fault. And then even if you can prove it's that the attorney is at fault, you've got to hope you can sue that attorney and prove to a jury that it was their fault. And then you got to hope that they're adequately insured. And if you have one attorney making the same mistake in the same tract or neighborhood, 2 or 3 homes blow a hole in the errors and omissions policy, and the rest of the homeowners get nothing. All this said, don't homeowners and the agencies need the protection of title insurance?
Absolutely. I would say that the enterprises require that the seller, whoever is selling the loans to them, or lender, that they represent that the home that's being purchased has first lien, that there's no superior liens, and that the title is clear. And the lender has to represent that that is true. And so what's typically been the case is people purchase title insurance, and I think Freddie Mac has been allowing attorney opinion letters since 2008. But when we looked at the numbers last year, I think there were only 45 borrowers that used this attorney opinion letter, and it's an option, and certainly that's one for the lender.
So only 45 people in the country have used this.
Just for last year.
For a whole year. I'm going to go on to another question that hopefully affects more people, and that is, Fannie and Freddie have talked about transitioning to a bi-merge credit report, relying on 2 credit agencies rather than a report where you need all 3 credit agencies. Now, there are only 3 credit agencies. So if you had a rule that requires all 3 credit agencies be used, none of those credit agencies has to do a good job, because you're guaranteed that you're one of the 3 participating in a 3-factor formula. Would we benefit from increased competition for better accuracy among the credit reporting companies if we just go to 2?
Sure, thank you for the question. So when we started looking at—
If you could answer that question in writing, please, Director. Thank the gentleman from California. The gentleman from Florida, Mr. Posey, is recognized for 5 minutes.
Thank you, Mr. Chairman. Ms. Thompson, could you give us a brief summary of the status of the lawsuit against Fannie and/or Freddie by the investors?
Which one?
Yeah, just—
Certainly, I think it was October last year, There was a lawsuit trial for Fannie against the investors, the junior preferred shareholders, not all of them, but many of them. And there was a DC trial, it was FHFA versus the junior shareholders. And there was a hung jury. And so there's going to be an upcoming trial in, I think it's July, that will further the issues that previous trial was dealing with. And that was, one, the settlement or the actual amount of the benefits to some of the junior preferred shareholders. A prior judge had limited that amount to, I think it was $1.8 billion. And so we're just trying to figure out what that amount is. And that's the premise of the trial that's coming up in July.
Thank you. Can you tell me the amount in legal defense fees the taxpayers have paid so far?
Sir, I will have to get back to you on that. The trial that I mentioned was the first jury trial, but there have been a series of trials for the past 14 years that FHFA and the enterprises have participated in, and I certainly would be happy to give you that number.
Yeah, I understand it was over 100 million years ago, many years ago. Yeah, I would greatly appreciate it if you could tell me the total amount of fees paid in defending Raines et al.
Sure.
Thank you. What steps do you think policyholders should make to move a greater share of the secondary mortgage market and associated risk to the private sector?
So I think that's a great question, because I know that the private market, it's important to have a balance of both the private sector and government. It helps competition, but it also helps home ownership because people are competing to get mortgage loans. And I have been through, for the past 30 years, the PLS market and the challenges that had, which is not completely gone, but mostly. I think that if there's any way to facilitate, more participation in the private market, I think that would be helpful. But as Mr. Hill said in his opening remarks, it seems like many banks are getting out of the mortgage business, and many of the non-bank lenders are servicing that market. I don't know if that's good or bad, but at the end of the day, it just seems like there could be more participation in the mortgage market.
Thank you. Does the Biden administration have a plan to release the GSEs from conservatorship? And if so, what's that look like?
Certainly, I actually don't know that we have a plan to release the enterprises out of conservatorship. I have not spoken with the administration about that. FHFA is an independent regulatory agency, and I do believe that meeting the capital requirements is really important. I think that making sure that the enterprises have appropriate capital, that they have appropriate pricing, and that they're able to meet commercially viable returns is a critical component of that. You want to make sure that people are sure about what they're investing in, both from the mortgage-backed security side and from investing in the company. So if they ever got out of conservatorship, they would likely have to have a huge capital raise. And there are a lot of questions that would need to be answered, but they also would have to have the capital requirements to make sure that they're in position to take care of any losses that they have.
Thank you. Broadly speaking, what role should risk-based pricing play in setting borrower and lender prices for GSE insured mortgages?
So risk-based pricing is very important. We currently have, after all of the concerns that were raised about the loan level pricing adjustments, we have issued a request for input that asks that very question. What role should the capital rule play in terms of setting the prices? What role should loan level pricing adjustments play? Should there be any? And so we're really looking for stakeholders to provide input on how we establish returns and pricing so that we can, answer that question responsibly.
Thank you, Ms. Thompson. Thank you.
Gentleman, time's expired. The gentleman from New York, the ranking member of the House Foreign Affairs Committee, Mr. Meeks, is recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you, Director Thompson, for the excellent job that you're doing at FHFA. Let me follow up, because I agree with the ranking member, and I don't think you got a chance to answer the question. You know, our Republican colleagues are threatening to default on our debt. And as the ranking member asked, what effect would that have on the housing market? You started, you only had about 6 seconds to go. So I want you to be able, I think it's important for this committee and America to hear what effect it would have.
Thank you. So I do believe that mortgage interest rates would increase, and to the extent that homeowners are impacted and they're not getting paid, and it would certainly impact employment, which would increase delinquencies for the mortgages that are owned by, Fannie and Freddie. And to the extent that delinquencies are increased, then we would have to start, making sure that the investors get paid. The investors, and fortunately, at both Fannie and Freddie, there's $100 million to cover losses, but I don't know how long, something like this would last, or how much would really be necessary to make sure that, investors got paid. And we lost a lot of confidence in the last Great Recession, through the PLS market and mortgage-backed securities investors. While they're worldwide, we were just regaining the confidence back. And so making sure that we have homeowners who can afford these homes, because again, these interest rates would be really high, is really important. Want to make sure that investors also have confidence that they're going to get their return on investment. So I think there would be some confidence issues on both the beginning with the borrowers and the homeownership, and then the end with investors and mortgage-backed securities.
Thank you. And that affects, as you were talking about earlier, the private market also getting involved, as well as the global market as far as confidence in what we're doing. So it will be devastating, in other words, and people will lose homes, and we know that those who are renting, they'd be faced with losing rental assistance in the middle of a housing crisis. So this idea of it actually is a default on America if in fact my Republican colleagues continue to move to hold the debt ceiling hostage. But let me move real quick on the time that I have left with talking about and discussing appraisal biases. As you know well, the appraisal is a critical part of the home buying process, and significant attention has been given to the bias and discrimination that have resulted in material loss for borrowers of color particularly. Now, I understand that you hosted the second of 2 public hearings on appraisal biases just last week. Could you provide any key takeaways from the public hearing, including specific steps that FHFA and the enterprises are taking or plan on taking to work towards more fair and equitable property evaluations?
Sure, thank you for the question. So we have actually issued over 43 million loans, or data on 43 million loans. We had to anonymize the data, but just to help with the discussion on appraisal bias. And we published the data last October, and we update it every quarter. And we have provisions so that people can use tools to look at neighborhoods and pricing of homes in different neighborhoods. And in many cases, homes in minority neighborhoods are appraised at lower values than loans in non-minority neighborhoods. And because we had started this conversation, most of the discussion was based on anecdotal data. And so now we have actual data from the enterprises, and people can go on our website, use the data, and come to their own conclusions. But I've seen a number of studies that do reflect that some of the appraisal numbers are much lower in minority neighborhoods across the country than they are in non-minority neighborhoods. But the data is on our website.
And what about in the appraisal profession? Can you tell us what outcomes the initiatives have been taken, including how many people of color have entered into the profession?
So there are a number of appraisers, and it's our understanding that the appraisal industry is aging and that there
The time of the gentleman has expired. I invite the director to be responsive to the gentleman's question in writing. The gentleman from Missouri, Mr. Lukemeyer, is now recognized for 5 minutes.
Thank you, Mr. Chairman. Ms. Thompson, I'm just kind of curious, do you ever meet with the president at all or talk with him about how his policies are affecting home ownership and the ability of your agency to function?
So I've met with the president to talk about home ownership, along with the secretary when we present a global perspective on home ownership.
Do you talk to him about what his policies are doing to home ownership, such as increasing rates, now his unwillingness to meet until about 2 weeks before the deadline with regards to the debt limit bill, how that all affects? You've already delineated what you think is going to happen here, higher interest rates could increase costs. Do you ever talk to him about that? Had your agency talked to his people, himself personally?
So we have conversations with the White House, we have conversations with Treasury, we have conversations with other regulators.
They listen to you.
Of course, everyone is.
They may hear you, but they don't listen, do they? Because we continue to have this increased situation. I just read in the paper again yesterday where the Fed looks like they're going to raise rates at least once or twice more this year. That's going to have a dramatic effect on the housing ability, our people ability to afford houses, is it not?
Rising interest rates is a huge contributor.
One of the things that I used to chair the subcommittee on housing and insurance here, and one of the statistics that I got from the homeowner or the housing, home builders people was that for every 1% of cost, increased cost to purchase or to finance a home, 100,000 people no longer had the ability to have a home. This is significant. That is really, really significant. That's devastating to the home builders associations, devastating to homeowners to not be able to buy homes because of increased costs. Inflated interest rates that continue to go up are devastating to homeowners, are they not?
High interest rates are very impactful to potential home buyers.
What's the reaction you get from the administration whenever you ask them about that or tell them about that? Do they care? To have 100,000 people every time you raise the interest rates like that and raise costs, 100,000 people no longer have access to homes.
No, understood. Housing is a big part of our economy, and I think everyone. It's a national.
So you're not
issue.
telling me that they react at all?
It's a national issue, and I think that people care about home
Yeah,
ownership.
but you're giving me the 30,000-foot view. I'm asking a very specific question, whether the administration actually responds to you and says, we're concerned about that. Do they ever say that?
Well, I don't know that we've talked about.
So now you're saying you don't talk to them at all
No,
about
I
this.
didn't say we don't. What I said was that we do talk to the administration about housing generally. I think everyone is concerned about home ownership, including the administration, including people that I've talked to in this room.
Well, it doesn't seem as though you're meeting with them on a regular basis and getting your message across. How can you not? That's your job, to talk about housing. How can you not be forceful and say, I'm an advocate for housing. I'm an advocate for people to have home ownership. Your policies are killing us right now. Please listen to me. And I don't hear that from you. I'm sorry. Ms. Thompson, you had a career with the FDIC, is that right?
Yes.
About 20 years. You were in charge of the examination enforcement program for risk management, correct?
That is correct.
So FDIC enforces capital requirements on its bank, does it not?
They do.
So you talked a little bit about this morning about the need to be about $300 billion of capital to be able to move out of conservatorship. And you're at what level right now, roughly, with the two GSEs combined?
About 100.
About 100.
Loss.
I know when I chaired the committee, it was about, I think, 20 or 25, which was about 6 years ago. So they're making progress toward that end. The problem is, as long as the GSEs are undercapitalized, it allows a whole lot of other things to go on. Would you, in your position as a risk management officer, allow the banks to engage in new activities if they were undercapitalized like this?
The banks would have to submit to their regulators.
You were the
proposal for new
regulator,
activity. Yeah,
Ms.
okay.
Thompson. So
we do
the
have-
question is, if you had banks that were severely undercapitalized, 100 billion versus 300, they're only a third of where they should be, and they wanted to expand their services into new areas they had no expertise in, would you go along with that?
would have to look at the plan submission.
Ms. Thompson, you know as well as I do, I'm a former examiner. That wouldn't happen. They would not be able to expand because they don't have the expertise or the capital to absorb the losses that are going to come because they don't know what they're doing in this area.
They would likely be on a capital plan, and to the extent that an activity would help increase their capital, we would have
Gentleman's
to
time is
thoroughly look at it.
expired, and
yield back.
thank the gentleman from Missouri, and director is invited to respond in writing. And now we recognize the ranking member of the House Agriculture Committee, Mr. Scott, Georgia, for 5 minutes.
Thank you, Chairman. Director Thompson, back in October of 2022, FHFA announced the agency's transition to a bi-merge credit report rather than a tri-merge credit report for GSE-backed mortgages. And I want to specifically focus on the portion that proposes to use an average borrower's 2 credit scores as the representative credit score for single-family mortgages instead of the lower of 2 credit scores. Under the current 3 credit report system, lenders have access to all available credit history information about potential borrowers. My concern is that by removing one of the reports from a lender's review, FHFA is potentially leaving out predictive and positive credit history out of the credit risk assessment. And while I agree that we need more competition between the 3 nationwide credit reporting agencies, I have concerns that this action could have serious implications for consumers planning to purchase a home. And my understanding is that FHFA and GSE officials say that the proposal is more sustainable than the old regime of FICO Classic reporting. So can you explain what your agency means by more sustainable?
Sure. So, years ago, there were 3 separate credit reporting agencies, and they had special information about certain parts of the country. One had information on, the West Coast, South, and Northeast regional. Having said that, we've made several advances in technology, and now there's national lending. And we currently require the enterprises to get credit scores from all 3 companies, and you have to pull a credit score for every borrower on the loan. When we initially undertook the credit score model update review, which is a separate but related activity, one of the things that we did was we took a look at if you get credit scores from 3 credit reporting agencies, what are the differences if you get it from 1 or 2? There were significant differences if you went from 3 credit reporting agencies to data from 1 credit reporting agency. So that's bi-merged to 1, but there was very little from 3 to 2.
Let me ask you about the risk. Has there been a review of the risk that this change could have on the underwriting process? And is there a mechanism in the proposal to ensure positive credit history is not left out of a borrower's credit risk assessment?
Right. So we have done an assessment on the differences between moving from 3 credit scores to 1 credit score and 3 credit scores to 2 credit scores. And again, the accuracy is not impacted very much, if at all, moving from 3 to 2. And we do believe that that would foster competition. With regard to including positive rental payments, that is something that's going to be, and currently is included in the underwriting systems for both Fannie Mae and Freddie Mac. If people report these positive payments, they are included and they get factored into the crediting decisions.
And let me ask you this. would you be willing to share this information with members of this committee so we can have a better understanding of the impact the bi-merge credit report proposal could have on our constituents?
Sure, we'd be happy to provide you a briefing with the information.
Thank you. And I think you're doing a wonderful job.
Thank you.
Gentleman yields back. Gentleman from Oklahoma, Mr. Lucas, recognized for 5 minutes.
Thank you, Mr. Chairman. Director Thompson, I'd like to follow up on the concerns that many of my colleagues have raised regarding the recent changes to the loan level price adjustments. When you compare the previous pricing grids with the new pricing grids that went into effect this March, there's some perplexing changes. For example, a borrower with a credit score between 760 and 779 with a down payment in the range of 15 to 20% will have a significantly higher adjustment under the new grid, while a borrower with a lower credit score between 640, 659 and the same down payment would have a significantly lower adjustment. You discuss in your testimony that one of the objectives of the new pricing grids is to assist lower income first-time homebuyers. Could you discuss how this policy objective is weighed alongside protecting safety and soundness of the GSEs?
Absolutely. So the grids that are in place right now are calibrated to the new capital requirements that the enterprises are subject to. The prior grid was outdated and had not been subject to any updates in over 8 years. In fact, the last time a change was made to the pricing grids was in 2000, maybe 2014. Since then, the enterprises have had what we call the conservatorship capital framework, and the pricing grids were not changed to reflect that framework, nor were they changed to reflect the new capital requirements. And so we believe that pricing needs to cover your income, needs to cover your expenses, and so we do believe that these new pricing grids absolutely reflect the cost of capital and other administrative expenses.
You can see why the several groups of borrowers, lower credit scores and lower down payments, having their fees reduced, while some with higher credit scores and higher down payments have their fees increased. See why this would be concerning to people looking at this. The GSEs owned and guaranteed approximately $7.4 trillion in mortgages at the end of last year. That is more than half the $13 trillion U.S. mortgage market. Is this why it's imperative that Congress play an oversight role in FHFA? Director Thompson, could you discuss what you view as the oversight role of Congress, particularly in identifying the risk and vulnerabilities within the housing finance sector?
Sure. So I think Congress has policy-making responsibilities for the entire sector, whether it's housing or other. And Congress certainly can do what it chooses to do, and we're happy to provide any information you need with regard to how we are managing and overseeing as conservator and regulator the enterprises and the home loan banks.
But where do you see the risks and the vulnerabilities these days?
Well, I think one of the risks is building capital and making sure that we have capital so that the enterprises can cover any losses. But there's also a dual mandate of making sure that liquidity is provided through this country, throughout the country, to borrowers everywhere. And that means across the country so that they can have access to home ownership. And I think there's a dual mandate that we have to be responsible for.
In our remaining moments, Director, Fannie Mae and Freddie Mac have been under the conservatorship since 2008, in which FHFA is charged with acting as regulator and conservator. Could you explain how your approach to both of these different responsibilities and what you see as the greatest challenge facing each?
Sure. So we believe that safety and soundness and sustainable access to credit are our mandates. Everything that we do at FHFA is wrapped around safety and soundness. We've got examiners on site at the enterprises. We conduct examinations at the home loan banks each and every year, and we make sure that they're accomplishing their missions in a safe and sound manner. We believe that both are attainable, and it shouldn't be either or, it should be and both, because we have the dual mandate to provide safe, decent, and affordable housing to Americans throughout the country, and that's how we approach our job.
Thank you very much. Yield back, Mr. Chairman.
Gentleman yields back. The gentleman from Texas, Mr. Green, is recognized for 5 minutes.
Thank you, Mr. Chairman. I thank the witness for appearing today as well. And of course, I thank the ranking member. Mr. Chairman, you might recall that in the last Congress, the Oversight and Investigation Subcommittee held a hearing on the question related to rental markets and tenant protections. I see where a recent ProPublica investigation alleges that RealPage, a company which provides a rent-setting algorithm to landlords and property management companies, it is being alleged that they've colluded with landlords to help inflate rental prices using private data. So the question becomes, Madam Director, of course, is this price-setting software or is this price-fixing software? And does this pricing algorithm allow landlords to coordinate prices and provide rental pricing higher than competitive levels? It's of great concern because we want to make sure that we protect tenants from egregious rent hikes. And this looks like a very clever means by which this can occur. So I'm concerned about how the FHA might play a role in protecting tenants. Can you give some commentary, please?
Sure, thank you. And the subject of tenant protections has been coming up quite a bit, and our agency is preparing to issue a request for input to get stakeholder input on this very issue. I read that same article, and Fannie Mae and Freddie Mac in particular are secondary market participants. They provide the funding or financing to lenders. And so we've asked them to talk to the lenders, who in turn talk to the property managers to figure out, one, are they using this type of algorithm to establish rents? But two, we want to make sure that we are balancing safety and soundness and tenant protections so that tenants certainly have rights, and also the multifamily lenders that build these properties are part of this conversation. So we're really looking forward to getting input on our request for input on tenant protections for stakeholders for loans that are backed by Fannie and Freddie.
Well, thank you for looking into this. I'm moved by this in part because when I was a neophyte lawyer, we were given a booklet that would give us suggested prices for various actions, divorce, one price, DWI, another. And this was found to be a violation of antitrust laws when you start pushing prices so that you create a price level that is beyond what would ordinarily be a competitive price. And this smells very much of what I experienced when I was a neophyte. And I'm really concerned to the extent that I may give you a written request. I don't want you to get blindsided. I may give you a written request as it relates to this, because from the hearing that we had, it became very obvious to us that major corporations were buying up these properties, and that somehow in buying them, prices were being elevated. This was immediately during the advent of the pandemic. Prices were being elevated. And not only were the prices too high for renters, but they were also buying properties that first-time home buyers could have acquired. So they were cutting into poor people, like poor people who don't have what rich people have, and in various ways. Your final comment, please.
We don't allow institutional investors to purchase these single-family rental properties. I think one of the enterprises did one transaction in 2018, and we have not allowed that since.
Well, thank you very much. I will yield back the remainder of my time.
Gentleman from Texas yields back. The gentlewoman from Missouri, Mrs. Wagner, the chair of the Capital Markets Subcommittee, is recognized for 5 minutes.
I thank the chair, and I thank Director Thompson for joining us here today. I just want to join my colleagues in their concerns with the recent changes to these home mortgage fees. I have heard from countless people in the housing community, home buyers, young and old, in Missouri 2nd Congressional District, that are adamantly opposed to this new Biden-era rule. What you're essentially proposing or doing is taking money from those with good credit that have spent years saving for a home and transferring it to more risky borrowers. We all agree that there is a housing affordability problem in this country, but it won't be solved by punishing those who play by the rules and did things right. And none of this will be solved by this unjust, socialist-style redistribution of wealth. Director Thompson, on May 15th, you did announce a formal request for input, an RFI, on the broader pricing change initiative after significant stakeholder, as I just reflected, and congressional feedback and concern. Now, this is one step in the right direction. However, I believe that you are putting still the cart before the horse here by releasing a new pricing framework without proper input first. Why did the FHFA neglect to formally request stakeholder input before releasing this new pricing framework?
So thank you for the question. You know, the FHFA reports on pricing every year to the Congress, and we also publish reports that discuss what the pricing requirements are.
But what about the input, stakeholder input?
Yeah, what I would like to say is we published the changes. I really wanted to say that the new pricing grids do not punish people with high credit scores and higher down payments than low credit scores. That's not the case. What people forget to look at is the cost of mortgage insurance.
Respectfully reclaiming my time. We couldn't see this, nor can the American people see this any differently. Given all the backlash from the FHFA's rollout of the recent pricing changes, will you commit to increase transparency and stakeholder input for actions like this in the future?
Sure,
Pardon?
yes, we will certainly commit to.
Now let me move on then. Lower credit quality borrowers are typically the first to default, and many experience extremely early payment defaults during times of economic stress. If more borrowers with worse relative credit receive Fannie and Freddie guarantees, could that result in more systemic risk for these GSEs, either one, in the short term, in an economy at risk of recession, or two, in the longer term as the credit quality of GSEs deteriorate?
Well, that's one of the reasons the enterprises require mortgage insurance, because if there's a default, the mortgage insurance steps in front of and has the first loss position and protects the enterprises and limits the enterprise's loss. And as we said, any loan that has less than 20% down is required by law to have credit enhancement.
We're all familiar with PMI. Director Thompson, I'm concerned with the FHFA's proposed actions related to the bi-merge, tri-merge transition, which would only require 2 credit reports instead of 3 to determine consumer credit scores. I am sure that you would agree that relying on incomplete and imprecise data raises the possibility of another GSE policy-created mortgage crisis. Lenders cannot accurately price risk and manage their mortgage-related exposures if they are relying on limited picture of borrowers' credit files. I mean, ultimately, the taxpayers will pay the cost if mortgage defaults increase. And like it or not, the most predictive of models, the single most predictive one is credit scores. So how would this change work, and who would determine which two reports to use? And at what juncture in the lending process would that decision be made?
So the decision would be made early on in the lender would choose the two of the three. We think it fosters competition and it lowers the cost for the buyer instead of getting reports from three.
Do all three have the same data?
Some have more data than others.
Yeah, that's
Gentlewoman's time has
problematic.
expired.
My time's expired, and ma'am, I have a multitude of questions in this arena.
The
that I'm going to
You
forward to
can
you.
respond to the gentlewoman
you.
in writing. Thank you, Director. The gentleman from Missouri, Mr. Cleaver, is now recognized for 5 minutes, the ranking member on the Housing Subcommittee.
Thank you, Mr. Chairman, and again, thank you, Chair Thompson. And let me also express appreciation for your availability and your staff's availability to discuss these issues of significance to us. It's always helpful. And particularly, I'm now very much interested in FHLB, Federal Home Loan Bank, which is in Des Moines, Iowa, about 175, 180 miles from me in Kansas City, Missouri. And so we ended up having a lot of concern and questions around the Silicon Valley Bank and Silvergate Bank because the FHLB had provided billions of dollars to both of those banks in the weeks that led up to their collapse. And so whenever that kind of thing happens, we are going to get questions. Well, I thought their priority was making affordable homes available. And if that is in fact their mission, and if they are backed up by the federal government, implied or not, how can they justify giving billions of dollars to two banks that went under?
Yes, so thank you for the question. And the home loan banks certainly we're part of the greater financial ecosystem, and we are conducting a review of the home loan banks, and we'll, as part of the report that we issue, have a discussion about the home loan bank's role in the failure of the three banks, or the two banks over the March 9th weekend. What I would say is we work very closely with the primary federal regulator, and they govern the permissible activities. But what we do is we try to make sure that the federal home loan banks are not the lender of last resort. That's supposed to be the Federal Reserve. And to the extent that, if home loan banks wants advances, then we certainly work with them. We assess their credit and look at just their activities over the quarter, because we don't get reports of examination, so we have to rely on our own member credit assessments. We, again, based on the requirement of law, are required to provide advances, and these advances need to be used for home ownership, home lending. They can be in the form of loans or mortgage-backed securities that are purchased to fulfill some of the collateral requirements when they're requesting advances. And so we really keep a close eye on the home loan banks. And as it relates to these failures, we're definitely going to incorporate the home loan bank's role into the report that we publish by the end of the third quarter.
All right, thank you. I look forward to seeing that. The federal home loan banks have over $1 trillion in assets. And we also are having a serious problem with home ownership or the lack thereof. Is it reasonable that the federal home loan banks play a more active and aggressive role in responding to the affordable housing crisis.
Yes, absolutely. We conducted numerous listening sessions around the country to talk about the role of the home loan banks. And almost at every session, many participants said that there was more that the home loan banks could do to be helpful in their affordable housing responsibilities. And so we will be, again, publishing a report that will list some of the suggestions that were made to really help the home loan banks better focus and enhance the activities around affordable housing in their respective banks.
I would hope that, since CRA is being looked at right now by these finance agencies, this might be a really good time to look at that in terms of a more active role. Thank you, Madam Chair. Thank you, Mr.
I thank the gentleman, and now I recognize the gentleman from Kentucky, Mr. Barr, the chairman of the Financial Institutions Subcommittee, recognized for 5 minutes.
Thank you, Mr. Chairman. Director Thompson, thanks for being here today, and I hear your argument that the FHFA's recent changes to loan level price adjustments does not punish borrowers with higher credit scores and down payments and won't impact them. But I have to drill down a little bit on your argument that this doesn't undermine risk-based pricing. Did the LLPAs assessed on any loans increase under the new pricing grid?
Yes.
In terms of credit scores, were there any price increases assessed on any loan with a credit score of 679 or lower?
I don't have the chart in front of me.
I think the answer is no. But the next question is really more revealing. Is it correct to say that all increases in the LLPAs under the new grid were assessed on loans with credit scores of 680 or higher?
I think the capital requirements for those loans, which the pricing grid is tied to, I think would reflect the risk distribution of those.
Yeah, the answer is yes.
Okay.
So every one of these higher fees goes to borrowers with credit scores higher than 680. And this is the problem that members have because our constituents have a problem with this. And it may advance a political agenda of equitable housing, but it doesn't advance the statutory mandate that you, as the FHFA director, have to promote safety and soundness. So what we think you're doing here by assessing higher fees on higher credit borrowers is you're actually contradicting the statutory mandate to advance safety and soundness, and you're putting taxpayers at risk. I want you to kind of take that feedback, evaluate it, and recognize that, yeah, in fact, the borrowers with the highest credit scores are the ones getting the higher fees. Let me follow up Representative Cleaver's very good questions about the Federal Home Loan Bank system. One of the key lessons from the recent bank failures is how quickly deposit outflows can cripple a financial institution. And Federal Home Loan Banks do have an ability to respond most instantly to their members' funding needs. This is particularly important for community banks and credit unions who otherwise don't have access to the capital markets. I hear what you're saying, that Federal Home Loan Banks are not the lender of last resort, but considering this recent history, would you agree that any suggestion to limit access to Federal Home Loan Bank liquidity could have negative consequences for financial institutions and consumers if residential mortgage assets can't be effectively liquefied or pledged through FHLB borrowing?
So I think first I'd like to say that even with these reduced fees, borrowers with high credit scores and high down payments will always pay less than borrowers with low credit scores and low down payments. That's FHFA's requirement, and we do believe that it's safe and sound. With regard to the Federal Home Loan Banks, the Federal Home Loan Banks have to issue debt. So when a member comes in, if they have a large requirement, the debt markets are not open 24 hours a day. And so what typically happens for the Federal Home Loan Banks is the members come in and they have staggered requests. And if they have a large request, then the Home Loan Bank has to plan for it because they have to issue debt to meet the funding requirement. And so we just think that planning, which is appropriate for the home loan banks, which are the second.
Thanks for your feedback. Just remember the important liquidity provisions that federal home loan banks can provide here. On credit risk transfer, the SEC's proposed conflict of interest rulemaking exempts the GSEs as long as they're in conservatorship, but whether or not the enterprises are in conservatorship really should have no bearing on whether the transactions impacted create a material conflict of interest with investors. I appreciate that you've restored capital credit for CRT and revisions you made to the Enterprise Regulatory Capital Framework, which supports ongoing issuance of credit risk transfer transactions that protect taxpayers. But is there any reason you can think of why the SEC should not simply write a rule that can apply to all issuers of CRT or similar risk mitigating instruments rather than relying on these clumsy exemptions that undermine efforts at housing finance reform?
So I think that FHFA, so we have no jurisdiction on what the SEC should or should not do. To the extent they issue a rule, we have a responsibility to respond on how it impacts our regulated entities. And that's what we've done.
I'm just making the point. I appreciate it, and I yield back.
Gentleman's time has expired. The gentleman from Illinois, Mr. Foster, is now recognized for 5 minutes.
Thank you, Mr. Chair. Director Thompson, a variety of people come in front of our committee and come to us individually for the private meetings ahead of time. And I have to say, when I encounter someone with your breadth of experience, your deep understanding of business considerations, and the strength of your moral compass, I just want to say I thank you for your years of service to our government and the people. Now, I've long been concerned about the cybersecurity risk that third-party providers may pose to individual financial institutions as well as our entire financial system, given how interconnected the whole system is, and the fact that many of these third parties are in fact core mission-critical providers to several important financial institutions. We have learned a number of painful lessons in the recent past about how cybersecurity attacks, about the effectiveness of supply chain attacks and third-party attacks are on financial services and elsewhere. I hope soon to reintroduce the Strengthening Cybersecurity for the Financial Sector Act, which this committee actually passed out of markup last session. This bill would give FHFA the authority to examine and regulate third-party service providers of its regulated entities. This is, as you're probably aware, very similar to the existing authority that prudential banking regulators like FDIC and others have over banks' third-party vendors under the Bank Service Company Act. The FSOC noted in its 2021 annual report that some regulators, including FHFA, continue to have limited authority to regulate and supervise third-party providers. So, Director Thompson, can you tell us the current extent of FHFA's authority over third-party service providers like Fannie, Freddie, and the federal home loan banks?
Sure. So thank you for that. And we have been asking for authority to examine third parties that are counterparties to the enterprises and the home loan banks for a number of years now. So please, thank you for raising the issue. Right now, we use our conservatorship authority because the counterparties have contractual relationships with the enterprises. But as a regulator, we think it's very important to have oversight or examination authority similar to what the bank regulators have on through the Bank Service Company Act on their ability to oversee and examine third parties that are critical counterparties to their regulated entities. We would like the same thing.
Yeah, well, I concur, and I hope Congress moves on what I hope is should really be a no-brainer on this. Now, are you involved in Vice Chair Barr's holistic review of bank capital and liquidity requirements? And in particular, will the report that you're generating, which I think you set a due date in September, really have a timeline that's useful for input into that, given the importance of the home loan banks in providing emergency liquidity?
We're not directly involved with the bank capital review that the Federal Reserve and the other regulators are undertaking, but I have committed to Vice Chair Barr and the other banking regulators that we would share information from the review that we're undertaking on the home loan banks because they're the primary federal regulators, and it's really important for us to continue to work together and communicate because these are all entities in the larger housing finance ecosystem. And so we will be sharing information with them along the way.
Yeah. Now, in your testimony, you mentioned the stress testing, capital stress testing of the enterprises. And we've, I guess, had seen the biggest drop in house values in the last 12 years, in the last year. And that fortunately has not been accompanied by employment, which is the other thing that can really wipe out capital rapidly. And so what can you say about the nature of the stress testing? Is the stress testing you do comparable to, say, a repeat of the 2007 to 8 crisis, or
Yes, so actually we use much of the information that's published by the Federal Reserve in their stress testing of their regulated entities, and we modify it to accommodate our regulated entity. Like we'll look at, high concentration of single counterparty. We look at home price decline, since we have a single asset, in a way that maybe others do not. And so we take what's publicly available and we modify it just a little bit, and we publish the results of our stress tests every year. And so we think that we want to be aligned where we can with the other regulators, and then make differences that are relevant to our counterparties, and then we publish.
The gentleman's time has expired.
Thank you.
The chair now recognizes the gentleman from Texas, Mr. Williams, for 5 minutes.
Thank you very much, and thank you, Director, for being here. I'm from Texas. I'm a car dealer in Texas, and I own multifamily properties in Texas. And I know that the White House has been pushing the FHFA to enact rent controls where they're going to tell me what I'm going to make. It takes away me wanting to do things. And multifamily property is part of their initiative to socialize the housing industry. Now, the law is very clear. FHFA does not have the authority to enact these types of rent controls, and inserting yourself into the free market and enacting rent controls would have the opposite effect. It keeps people like me from wanting to build. It does away with competition. It keeps people from having places to live. And we would see a reduced housing supply by you getting in the market. And lack of investment, you wouldn't see that. And rental costs being pushed onto other tenants, that's what happens. And the focus should be shifted toward, I believe, increasing housing supply by reducing inflation, lowering interest rates, and getting the supply chain under control, and doing away with regulations for people like me that want to build and help people. And it's really hard to go borrow money when you have a cap on what you're going to make. So all of these factors will lead to an increase in home development and investment, driving the supply of housing up and the price down if you do those things. So you're worried that, Ms. Thompson, are you worried about the implementing of rent caps and other regulations? Do you think that could harm the housing market like I'm talking about, and make it even more difficult to develop housing along with other economic challenges, and discourage people like me from building?
So it's a great question, and we really want to get all sides on this issue. And this is why we're going to issue this request for input, because we want to make sure that the policies that we're undertaking make sense for both a safety and soundness perspective and for the tenants. And so we're really looking forward to getting information that can address this very issue that you've raised. We, FHFA, don't have a lot of input or influence on the supply chain. We do participate in the supply on the multifamily side through LIHTC investments. We've allowed both enterprises to have $850 million each of LIHTC investments, and half of that has to be in counties like rural and manufactured housing counties across.
Well, caps and forbearance and that does not help people that want to live in a decent homestead. So the next question: when traveling back in Texas, where I live, I continuously hear about how the dream of homeownership is becoming more and more unattainable for individuals in my district. Now, it's critical that we support new innovation designed to create more choices for consumers. One solution to reducing prices in the housing space could be through a new innovative approach, such as direct mortgage insurance, which I know you're familiar with, which brings new private capital to the market and reduces risk for taxpayers. Now, unfortunately, due to the political pressures and lack of action by the Biden administration, this is a model is ready to launch, but has not been approved as a standard product offering. So my question is, why is the Biden administration standing in the way of competition, which creates a lot of great things for consumers and innovation that would lower costs for borrowers? And what are thoughts, what are your thoughts on the direct mortgage insurance approach that could bring new capital to the market? Where does it stand with the FHFA currently?
So thank you for that. The product that you mentioned would be considered, I think, we'd have to make a determination as to whether it was a new activity or new product for the enterprises, and it would warrant making sure that it was publicly available so people could have public comments.
But if it lowers costs, isn't that a good thing?
Well, lowering costs and improving risk management is always good, but our rules suggest that this might be a new activity or new product, and we wouldn't want to make a decision that would be impactful without getting input. So we would have to.
Big government wins again. Okay, secondly, or lastly, the GSEs have been in conservatorship coming up on 15 years this fall since the financial collapse in 2008. And the former FHFA director, Calabria, made it a priority to get these enterprises out of government control and back into the hands of the private sector. And he had a clear focus for the agency, and every action seemed to be building towards the ultimate goal. However, since you have taken over, serving as director of the FHFA, it does not seem like there is a similar focus on working to get away from the conservatorship. So, meaning GSEs remain under government control and continue to financially backed by American taxpayers. FHFA must work to bolster the capital levels of GSEs to better protect taxpayers from undue risk. So real quick, what's the FHA doing to build capital in hopes of eventually exiting conservatorship?
Well, we're implementing the new pricing grids that are.
The gentleman's time has expired, and I would ask the director to respond for the record. The chair now recognizes the gentlewoman from Ohio, Ms. Beatty, for 5 minutes.
Thank you, Mr. Chairman, and thank you, Ranking Member Waters, and thank you for being here today, Chairwoman Thompson. Mr. Chairman, let me make this a statement because my colleague from Missouri asked Madam Director about her relationship in meetings with the President and the White House, and I heard a different response. So I heard her say, yes, she meets with the White House, has met with the President, and she has presented information. I did not hear her say they did not listen. And as Chair Emeritus of the Congressional Black Caucus, I can say that on housing, thanks to this chairwoman and data and resources that she supplied to me during my tenure as chair, we were able, along with information that came from Chairwoman Waters, we were able to present housing information to this president. Unlike the last president, since it's been introduced about what presidents do, the last president did not know who or what the Congressional Black Caucus was, although we represent 80 million Americans, 18 million Black Americans, and for the last 52 years, Democrat and Republican presidents have met with us, and housing has been an issue. So thank you for that. Let me continue with what Congressman Meeks brought up. We have held hearings in this committee led by Chairwoman Waters and others over the last two Congresses that dealt with looking at diversity, equity, inclusion, and some of the biases with appraisals. Your time ran out when Chairman Meeks was starting to ask about representation of people in color and biases in this profession. Is there anything you'd like to add to that?
Yes, thank you. In terms of appraisal diversity, I know Fannie Mae and Freddie Mac have worked with, I think there are 29 sponsors to bring diverse clients, diverse persons into the appraisal industry, because again, it's aging out and it's less diverse than other industries. And that was one of the things that came out at the hearing that we had last week, Friday, at FHFA with the appraisal subcommittee. Right now, there are 469 scholarships that have been given by these 29 sponsors to persons who are interested in serving in the appraisal industry. There's not a lot of knowledge at colleges or HBCUs or community colleges about that, so there's a lot of outreach that's being done. But what's happened is when people hear about it, they want to find out more, and so there's been a lot of interest in the appraisal industry by diverse persons and diverse organizations, and we're trying to make sure that we accommodate that in any way that we can through the private sector.
Thank you. As the former D&I chair, I really appreciate that. Certainly, we all know that the FHFA was created by the Housing and Economic Recovery Act to restore the confidence and stability in mortgage markets in the wake of what we experienced in 2008 with that financial crisis. One of your agency's primary goals is to ensure that the enterprise and the federal home loan banks are operating in a safe and sound manner and serve as a reliable resource of liquidity in the housing financial market. What is FHFA doing under your leadership to help ensure the safety and soundness in the housing finance market? If anything you'd like to add.
Yes, thank you. So we are looking at the operations of the enterprises and our regulated entities. We've got examiners on site, and we conduct regular examinations. We're also looking at ways for the enterprises to build capital so that they don't have to rely on the taxpayer support should there be losses. We are looking at ways to both help home ownership in a responsible way, because one of the things that we learned from the crisis was it doesn't make sense to put people in a home if they can't stay in the home. It's a lose-lose situation. And so we focus on sustainable home ownership, and safety and soundness is embedded in everything that we do at FHFA.
If an economic crisis were to occur, do you think you have what you need at your disposal, or is there anything else Congress can do to help you?
We'd be happy to work with the Congress on any way to help with looking at ways to make home.
The gentlelady's time has expired.
Thank you, Mr. Chairman, and thank you to the witness.
Chair now recognizes a gentleman from Michigan, Mr. Huizinga, for 5 minutes.
Right here, Director. Thank you for being here, and I appreciate your testimony. Director, do you believe it's appropriate for the FHFA to prohibit GSEs from varying their pricing solely based on the origination channel of a loan?
I think the pricing grids are based on the capital and the performance of the different origination channels.
Okay. So would you agree that one loan no more or no less risky than an equivalent loan with an identical characteristic simply because it was originated through a third party would be a bad idea?
So I would agree. I think one of the points that was made earlier is the transition from the retail channel, the banks, to non-bank mortgage servicers and lenders. And I think we need to get some data that would show the experience on loans originated by channel so that we could look at the losses associated with it and then have capital reflect what the performance has been so we could price them appropriately.
Okay.
It would be helpful to have data.
So while GSEs should be permitted flexibility to adjust their pricing frameworks to meet their mission and safety and soundness objectives, obviously, I don't believe they should be permitted to implement pricing that violates the principle of equal access to the secondary market. You noted in your testimony that FHFA's statutory mission of ensuring the safety and soundness of the regulated entities and promoting access to affordable and sustainable housing includes first-time home buyers and underserved communities, and I applaud you for that. I'm actually a former licensed realtor, and when I got my real estate license, I was taught one thing: everyone is green. Doesn't matter where you're from, what language you speak, or what your religion might be, or anything else. Can you afford it, or can you not afford it? So I'm curious, do you believe the reports that disparities in pricing for third-party organizations, TPO loans, are a departure from the core level playing field principle that FHFA has established?
So I would want to see data that showed by channel what the loss experience has been so we could appropriately account for the...
Should there be a difference, though?
I hope not. I hope not, but I really would like, the data would be helpful and more informative for me to answer the question.
Okay. Moving on, your appearance before our committee last July, I submitted a question for the record concerning GSEs and perceived steps that were taken to limit acquisitions of mortgage loans sold through third-party originators. Your response was, shall we say, I would characterize it as lacking. You said that FHFA must account for appropriate risks, including those associated with loans originated through the third-party broker and correspondent channels, but TPO underwritten loans provide an alternative competitive product that lowers costs and can actually reduce interest rates on low and middle income borrowers, driving the mission purpose of why you are there at FHFA. Here's what I'm hoping to hear from you. I'd like you to commit that you will provide my staff and this committee staff with the analysis that you and FHFA used to determine any of the price changings in the pricing frameworks. And I would like to know what kind of analysis you have conducted. You've been referencing getting more data, but if you've taken some actions, so what is that based on? And I'm especially concerned what this means for our low and middle income borrowers. In my district, we are wildly diverse in that we have urban, suburban, we have urban, suburban, and rural areas, and very poor in all of those. I want to make sure that those borrowers are being treated equally. So will you commit to working with us and giving us that information?
Absolutely, and I would also mention that many of the borrowers, if your area median income is less than 100, if you're first-time home buyers, your upfront fee was eliminated. And so I would really want that message to get out that for first-time home buyers, the upfront fee was eliminated. You do have to continue to have the mortgage insurance, and your costs are going to be higher than someone that has a higher credit score and a higher down payment. But the upfront fee for first-time home buyers in rural and urban countries throughout this country.
Well, many of us, in my remaining 3 seconds, many of us are concerned about that disparity and making others.
Gentleman's time has expired.
Thank you. I yield back.
The chair now recognizes the gentleman from California, Mr. Vargas, for 5 minutes.
Thank you very much, Mr. Chair, and I thank the ranking member, Waters, for this hearing, and I especially want to thank Director Thompson. I have to say that I want to join with my colleague, Mr. Foster, and to thank you for the service that you've given, your deep knowledge. I have to say that I think you're doing a great job, and I've enjoyed your performance today in the sense that in a few times they tried to put words in your mouth, especially with respect to the president and what you said and what you didn't say, and you corrected the record very graciously. So again, that normally doesn't happen here. Normally, there's a tit for tat, and instead you did it better than anyone I've ever known to do it. Now that I've praised you, I do want to ask you some questions that you probably don't know the answer to, and not in your bailiwick, but because the other side brought it up at the beginning, I have to ask. And that is, do you know what the inflation rate is of the EU and the UK?
I'm sorry.
That's right, and you should, there's no need for you to know, but President Biden was blamed for the inflation rate that we have in the United States, which is lower than it is in the UK, which is over 10%, we're at 4.9, and also lower than it is in the European Union. And yet, Biden's policies are not the European policies, not the UK's policies. We have inflation all over the world because of the pandemic, supply chains, all sorts of issues. And yet each and every time my colleagues want to blame Biden. It didn't work. They used it in the last election. They didn't get the wave that they thought. They're trying that old trick again. The reality is it's a worldwide phenomenon. We're doing better than the rest of the world. That's the reality. Now, all that being said, I do have a problem with the prices of homes. That's the real issue. And I'll give you a good example. I just went on an inflation calculator, 2 of them here, and I took a look at, I bought my home in 1993, my wife. We paid $176,000 for it. Modest home, but it's unique. It's a historic home. Today, it would be worth $369,000 in the U.S. inflation calculator. Under the asset calculator, it would be worth $355,000. That's reasonable. So if somebody, again, wants to buy a house for $369,000 in California, that'd be very reasonable. I think that would be fine, and people could afford that. Problem is, they don't go for, the median home in San Diego is over 800,000 now. And in my neighborhood, it's over 1.5 million. So people can't afford those prices. I mean, what can you do about that? I mean, that's the real issue. I mean, it's supply. If you had more supply, and people want to live in California. People say they don't want to live in California. Every time a house goes up for sale, there's all sorts of people trying to bid on it. So what can we do about the supply? That's the issue.
So we'd be happy to work with the committee on anything that we could do to help address the supply issue. We don't directly have an impact on that, but we certainly could have some ideas on things that could be done and would love to work with the committee to try to address those issues. There's a huge housing shortage, as you mentioned, across the country.
It's across the country, different types. I mean, in California, I think we need more attached product, which becomes a little more tricky because we're not used to that product, but we have to have it if it's going to become affordable.
No, that's a great point. One of the things that the enterprises have done is they've changed the underwriting requirements to allow more the accessory dwelling units, or ADUs, and sometimes they're called like granny units, and they allow income to be used as in part of the calculation. But just looking at manufactured housing and just different ways to think about different types of homes that can really help at the affordable level, throughout the country.
Okay, and with the last few minutes, the seconds that I have here, 50 seconds, you were asked about the Fed's fund rate, and do you have anything to do with the Fed's fund rate? Do you call up Mr. Powell and say, hey, lower it or raise it?
No, I do not.
Of course not. Of course not. That was put on your bailiwick earlier, and it's ridiculous. Some of the things that my colleagues come up with on the other side of the aisle sometimes surprise me. With that, I yield my time back. Thank you, Mr. Chairman.
Thank you, Mr. Vargas. The chair now recognizes the gentleman from Georgia, Mr. Loudermilk, for 5 minutes.
Oh, thank you, Mr. Chairman, and thank you, Director Thompson, for coming in and speaking with us today. I want to echo some of my colleagues' concerns over the loan level price adjustment changes that took effect earlier this month, but I'd also like to echo some of my colleagues from Georgia and Missouri on the bi-merge, tri-merge transition. As Ms. Wagner pointed out, I don't think anyone would argue that all three credit reporting bureaus reflect exact same information about a borrower, and thus they aren't interchangeable. Excluding a single trade line could move borrowers up a credit score band, increasing risk for lenders. Additionally, there's an element of hazard. If only two scores are used, how do you plan to prevent lenders or borrowers from gaming the system and using the two most favorable scores?
Great question. And we have a proposed rule out for our capital rule. And one of the questions in that rule is related to the bi-merge, tri-merge, and how should we calculate it? Because right now it's a two-step process. You take, the median and then the lowest score based on the two borrowers. And should we move from median to average? And just how do we make sure that if the lender doesn't like two scores, and if they pull a third one, that they're not using that? So one of the things that we're talking about is making sure that if lenders pull 3 scores, they have to use all 3 scores. But if they pull 2 and don't like the 2, then they have to make that submission. But we are doing a request for comment on that in this new capital rule, and the comments just closed. I think it was May 12th, I'm sorry. But that is a question.
So this is something you're still working on. You really haven't come up with a conclusion of how you're going to do this?
We're getting input from the people that are going to be using this.
So what about in the reverse situation, just as it could move borrowers up a band, missing critical information or a trade line could force millions of credit-worthy consumers down to a lower credit score band? Wouldn't this reduce access for borrowers who would otherwise be deemed credit-worthy?
So in addition to the credit score, the enterprises both have their own underwriting engines that they use, and this is an input to that. And so they try to take as much information as they can to make a good underwriting decision. I know Fannie Mae uses trended data, and I think Freddie either is or does, which doesn't just talk about what gets paid, it talks about how it gets paid as well. And so there's just a lot of information that's available that goes into the underwriting decision, And based on the analysis that we did, we thought that moving from 3 credit scores to 2 did not detract from accuracy of the borrower's final credit score at all.
So what credit score models did you use for validation studies? The FICO 8, FICO 10,
So we,
Vantage score?
so 2 models were validated by the enterprises, FICO 10T and Vantage Score 4.0, and we're working on a multi-year implementation process to change from classic FICO, which is over almost 30 years old, to these new credit scoring models. And so updating the credit scoring models has been a priority for the agency for years. And so FICO 10T and Vantage 4.0 were validated by the enterprises and FHFA.
So are you planning on validating by merge across all the models before implementation to evaluate the impact of the average scores?
The bi-merge, tri-merge process is outside of the credit score model update. So the credit reporting agencies generate the score and they send it to FICO or they send it to Vantage. They also send it to the lender. So the lender would have the 2 scores and they'd either take the lower of the median or the lower of the average.
So my last question, I'm running out of time here, is we all know that if a lender misses information, makes a loan to someone who can't or doesn't pay back, that affects every consumer across the board. Is it a good idea to limit any information to lenders when a house is the largest purchase most people will make in their lifetimes? And it's the most critical. Are you concerned at all about the adverse effects this might have if lenders become more risk adverse due to incomplete information?
So we think this would increase competition. Again, when we looked at moving from 3 scores to 2, there was really no difference in accuracy.
The gentleman's time has expired.
Thank you.
The chair now recognizes the gentleman from Nevada, Mr. Horsford, for 5 minutes.
Thank you, Mr. Chair, and to the ranking member. Thank you to Director Thompson for appearing before the committee. I want to start by commending your diligent work to expand opportunities for home ownership to hardworking Americans while never sacrificing the safety and soundness of the government-sponsored enterprises. I'd also like to applaud your thoughtful decision to rescind the proposed loan level pricing adjustment fee on borrowers with debt-to-income ratios greater than 40%. We heard just last week from experts such as the Realtors President, Kenny Parcell, who reiterated the increased uncertainty that low-wealth homebuyers would face if these carried that additional fee. The new price matrix will help lower wealth borrowers and increase access to home ownership for first-time home buyers. Now, I represent Nevada. My district's 50,000 square miles. I have rural areas and urban areas, and I'm particularly concerned with the rural communities who have lower home prices than some of the ballooning housing market in Las Vegas, but who fit the profile of high credit but low wealth. And I look to these rural areas as an opportunity for entry-level home ownership. So thank you for making them a priority. I also find it interesting when I hear this debate about credit worthiness. We just had bank executives here the other day who won't even take accountability for their lack of performance and governance on the banking institutions that they have responsibility for, but yet somehow we will target individuals and question their credit worthiness on formulas, in my opinion, that are out of date, antiquated, and I'm glad that you have decided to look to more updated models, particularly after the housing collapse of 2008, the pandemic that we've endured, that people are coming out of. It's time that we allow people the ability to show their worth is in investing in themselves and their families, and one part of that is through home ownership. Now, Director Thompson, as you are aware, there has been renewed debate around how credit scores may bake in a history of discrimination. Could you please discuss your view on the impact that over-reliance on credit scoring could have for majority-minority communities? And additionally, I noticed a recent announcement from the FHFA that validated the use of additional credit scoring models, so could you discuss how this potential change will help equitably expand access to credit?
Sure, thank you. The enterprises had been using the classic FICO credit score model for years. Classic FICO is almost 30 years old, and it was time to update the models. We had a process that the enterprises went through where they validated applicants. So we said, we're updating the credit score models. Anybody who wants to be the new credit score model can submit an application. So we had an extensive validation process. And what we found was that both FICO 10T and VantageScore 4.0 both met all of the tests of accuracy, reliability, but they also were more inclusive. What's different today is, these new models include positive rent payments, they include payments for utility bills, they include payments for things that weren't in place 30 years ago.
Yeah. And that's the point.
Yeah.
So you're telling me, and I previously was serving on the Ways and Means Committee, and this is the inequity that's inherently baked into some of the instructional inequities. So a homeowner can be treated one way and get credit, but a renter who pays on time gets no credit. But now you're accounting for that in your new methodology. Someone who is paying their utilities on time and their phone bills on time can now use that as a sign for credit worthiness.
That's correct.
I appreciate that. I'm going to just turn quickly to another issue that I'm concerned about, and that's the role that the enterprises have in stopping subsidizing home purchases from particularly out-of-state corporate speculators that are buying up a bunch of properties. And I do believe the federal government has a vested interest in this because of FHFA's role. I've introduced a bill, H.R. 702, the Home Act, which would crack down on these corporate speculators, and I would like to work with you and your agency.
The gentleman's time has expired.
To ensure that there is the accountability in place to protect
As I said, the
homeowners.
gentleman's time has
Thank
expired.
you, and I yield back.
Chair, now I recognize myself for 5 minutes for questions. Director Thompson, thank you for being here today. Thank you for your testimony. And you and I have spoken about the loan level price adjustments that drew quite a lot of attention lately. Do you feel that, well, I guess at some level, the RFI that you announced after you implemented the price indicates that there's some openness to more input? Do you feel like there was a way to get more transparency up front so that this was better understood?
Absolutely. I think that we do, again, publish every year what the pricing is and compare it to what it was, because when the enterprises were first put in conservatorship, they were given pricing discounts to larger sellers versus smaller sellers, and we want to make sure there's a level playing field for both, large banks and community banks as well. And so we are very conscientious about what they're paying and who's paying what, and we've got, the report has it by LTV distribution and DTI, you name it.
There, as we spoke, there are a lot. We could fill up all my 5 minutes trying to talk about it, but I appreciate you taking the time to do the RFI now. And so just last week, when our subcommittee on housing and insurance met, we noticed a bill called the Middle Class Borrower Protection Act. I introduced that with colleagues yesterday. And the bill reverts to the old LLPA prices and freezes those prices for a year pending a GAO review of the current process. It would require FHFA to conduct a notice and comment procedure for future LLPA periods. And frankly, that probably would have dealt with some of the transparency challenges, I think anyway. And it mandates that FHFA use risk-based pricing principles. Lastly, it prohibits future fee changes based on debt-to-income ratios. So thank you for withdrawing that effort. So do these proposals seem reasonable to you?
Congressman, I haven't looked at the proposals in depth, but we'd be happy to work with your office on any proposed legislation that you have.
Thank you, Director. I appreciate that. And I want to turn now to a little bit of attention on the federal home loan banks. And You know, recently you finalized a review of the Federal Home Loan Bank system at 100. What can you provide in terms of a timeline on when to expect your findings? And can you go into more depth as to what FHFA will recommend from a legislative standpoint?
So thank you. We hope to have the report by the end of the third quarter, and we will include in that report what we heard at the various listening sessions we had across the country, as well as an overview of the Home Loan Bank's performance or role in the bank failures. What we heard was across the country that the home loan banks certainly served their mission, especially for community banks, and I think that was evidenced during the most recent few weeks with the bank failures. But what we also heard was there's a lot more that they can do to be helpful in affordable housing and community development. And we also heard that there were, people had views on, the number, they had views on membership, and so we're going to consolidate all of that information and talk about kind of what we heard.
Are you going to address liquidity? Because I think that's one of the big things that's been a key part of the liquidity for, in particular, community banks.
Absolutely. We will discuss liquidity and again remind, and I think the members know this, that the home loan banks have to issue debt to meet liquidity requirements, and the debt markets are not open 24/7. And so if they have these large requests, we need to plan them out because the home loan banks are not the lender of last resort.
Yep, thank you for that point. And then lastly, as you talk about the enterprises, Fannie and Freddie, their retained earnings have been higher in spite of not necessarily the same top-line revenue. When you look at the goal that you set, I think $300 billion, or the goal that has been set, $300 billion, what is that in relation to the size of the portfolio, and how is that determined? What, at the rate they've been retaining earnings, how long till they reach that?
Well, it'll be a long time. So the capital rule was established in 2020, and those established the requirements for capital for both enterprises. They just started having the ability to retain capital in 2021, so to come to almost $100 million in 2 years is quite interesting, but it's going to take a while to get to $300 billion. Quite frankly, the mortgage pipeline is much lower than it was 2 years ago, and the earnings are down.
Thank you, Director Thompson. My time has expired, and I now recognize the gentlelady from Michigan, Ms. Tlaib, for 5 minutes.
Thank you so much, Director, for being here. Is FHFA looking at improving access to small dollar mortgages?
Yes.
Particularly really hard for my community in Wayne County, Michigan. According to HUD, we count for the largest share of nation's lower priced homes. My colleagues hear me talk about small dollar mortgages consistently for the last 5 years I've been on this committee. And I can't believe it's actually harder to get a mortgage for less than $100,000 than one for over $100,000. It is my understanding that Freddie Mac and Fannie Mae provide lenders a higher fee, or they call it the org fee. Yeah, small dollar mortgages to encourage lending. Is that correct?
Yes, small dollar mortgages have been a huge impediment to try to either originate or refinance. What we're finding, especially during the refinancing boom, there were a number of borrowers that had really high interest rate mortgages, but their balances were under $100,000, and the cost of closing was really impactful to them. And so we wanted to make sure that we included small dollar loans in our view, because there are communities around this country where this issue is very impactful.
So, could such subsidies be increased or expanded?
We'd have to take a look at that, and we'd be happy to work with your office on this issue.
Do you think it could be possibly implemented through FHA as well?
I would have to have a conversation with them, but I do know that this is a very...
Could you at least commit to talking to them about it?
Oh, absolutely.
Okay.
Absolutely.
Another option for making small dollar mortgages more viable for small lenders is to leverage the secondary market by pooling some of these small loans. The government-sponsored enterprises, for example, have proposed pilot programs to, secure personal property loans on manufactured homes, for instance. Ms. Thompson, Director Thompson, what are your thoughts on such efforts? Have either of the enterprises taken steps to establish such pilot programs?
So the enterprises have looked and are able to purchase manufactured homes, and they've got the requirements in their selling guides. And we've seen an increase in the number of manufactured homes and manufactured home communities that both enterprises have purchased. And we're happy again to work with your office on this very important issue.
I would love to work with you on this. Are there other ways to leverage secondary market to encourage small dollar mortgages? Loans.
So we would
I'm genuinely interested.
This warrants certainly a conversation, and we certainly would want to talk to some MBS investors to see what kind of information they would need to help facilitate the liquidity for these types of mortgages. But again, we would love to talk further and in depth with you about this.
So you know during the crisis in 2008 that enterprises were taken into conservatorship by your agency, and you know ultimately you have authority over them. I mean, right now, technically, maybe legally, Director Thompson, could FHFA require the enterprises to do pilot program to facilitate small dollar loans?
Well, certainly, the enterprises have a number of pilot programs, and again, we're trying to be very transparent about the pilot activities we have.
On small dollar mortgages?
I think in some of the equitable housing finance plans, there are references made to some of the small dollar loans because they do impact underserved communities. But I'll have to take a look and just be more specific with you.
I think it needs to be more targeted and more intentional, truly. We lost more Black homeownership, Director, in Michigan than any other state in the country. And we haven't truly recovered after the 2008 recession. And we have now neighborhoods that were thriving in the city of Detroit and even neighboring communities like Inkster and other places where we have now more renters than homeowners because private equity firms have been able to gobble them up, not even on mortgage foreclosures, on tax foreclosure, which we've been working with Secretary Fudge on and working with using ARPA dollars to help those families. But I think being much more intentional. I know there was a report came out, and that's great, but I think my residents are tired of studies and reports and want us to do much more in actually implementing. The last thing is, I want more credit through the Community Reinvestment Act for small dollar mortgages, something to incentivize more of these lenders to do that. Again, I know it's not going to be profitable as much as over $100,000 mortgages, but communities across the country are suffering because of that. So I want you to look into that as well.
Gentlelady's time has expired. The chair now recognizes the gentleman from Tennessee, Mr. Rose, for 5 minutes.
Thank you, Mr. Chairman. Thank you to Chairman McHenry and Ranking Member Waters for holding this hearing, and thank you to Director Thompson for being with us today. And thank you for meeting with our team last week and talking about the industry, including mortgage insurance. And I think we clearly share the goal of trying to make the dream of homeownership as attainable and affordable for as many Americans as possible. But of course, you understand we also have to protect the taxpayers of this country. And so thank you for spending time with me. Last October, the FHFA announced that it approved 2 new credit scoring models for conventional mortgages, FICO 10T and Vantage Score 4. FHFA recently announced its proposed implementation timelines whereby the agency would, number one, begin delivering and disclosing historical data for both scores to support credit model updates in the first quarter of 2025, and secondly, incorporate credit score model updates into its capital and pricing by the fourth quarter of 2024. As you know, this is a complex undertaking that will have a broader impact on the GSE capital rule. The rule says, and I quote, "The enterprises currently rely on classic FICO for product eligibility, loan pricing, and financial disclosure purposes, and if the enterprises were to begin using a different credit score for these purposes or multiple scores, the grid for new originations would need to be recalibrated." So, Director Thompson, can you expand on the ways FHFA is preparing to recalibrate given the 2 new credit scores, and how do you think moving to the 2-score model impacts the enterprise capital rule?
So thank you for the question. We are engaging with stakeholders, and there are lots of stakeholders that use the credit score model. It's not just the enterprises or lenders. Credit scores are used for underwriting, they're used for pricing, they're used for pooling. The mortgage insurance companies use it, investors use it. And so it's going to be a multi-year effort. We're working with the enterprises to make sure that we talk to and provide data to stakeholders who are going to be impacted by this change. What people will want to know is, here's the credit score that is associated with a particular loan. How does that calibrate or tie into these new scores? And so we're really looking at publishing data so that stakeholders can make those assessments so that they can be comfortable. And we're not wedded to timelines particularly. We just want to make sure that everybody has the information they need so they can make a credible decision, because it is so impactful in the mortgage market. We did think it was important to update the credit score model because, again, the enterprises have been using classic FICO, which hadn't been updated. Well, it's been updated, but it's been around for almost 30 years and doesn't take new ways of doing things into consideration. And so we want to be very careful with the update. We want to be very inclusive, and we want to provide data so that people can make really good decisions about this.
Thank you. Following up on some of my colleagues' concerns about the current or the recent tri-merge credit score changes, Director Thompson, what impact, if any, do you think the tri-merge to bi-merge changes will have on FHA loans and VA loans?
So we've done some analysis, and again, we don't think that moving from bi-merge to tri-merge to bi-merge has material impact. We know that moving from 3 scores to 1 score has huge impact, so we did not recommend that. We do work with and talk to our colleagues from FHA, VA, USDA, and HUD, and we are constantly engaged with them on this and other housing-related issues because we want to make sure that we're coordinated. We are going to be working with them, and they're going to be one of the stakeholders that's included in all this outreach that we're doing, because they're going to have to make those assessments as well if that's the direction that they choose to take.
Thank you. Quickly, with the last remaining moments here, do you believe that any government guarantee should be paid for and should come behind significant private capital in the first loss position, kicking in only in the most catastrophic of economic crises?
I believe in capital, and capital, not just the quality, but the quantity of capital. So there ought to be a loss absorption ability first and foremost.
Thank you. My time's expired. I yield back.
The gentleman from New York, Mr. Torres, is now recognized for 5 minutes.
Thank you, Chair. Even though the Federal Home Loan Bank system exists for the purpose of housing finance, as you know, federal home loan banks made $30 billion in advances to Silvergate, SVB, and Signature for reasons that appear to have nothing to do with housing finance. Silvergate specialized in banking the crypto industry, SVB specialized in banking the tech industry. Neither one had a particular focus on housing that would justify a massive liquidity injection. Do you think the $30 billion in advances to Silvergate and SVB are an example of mission creep on the part of the Federal Home Loan Bank system?
I think that the activities of the bank itself are certainly up to the primary federal regulator. When an institution that's a member of the Home Loan Bank system comes to the Home Loan Bank for advances, they have to provide collateral, and we haircut the collateral so that the advances are protected. When we provide advances, or when the home loan banks provide advances to the member, they have to, or they should be using those funds to either buy mortgage-backed securities or increase community lending or home lending in their respective communities. Many of these institutions—
So it sounds like you would agree that it was mission creep.
Well, I don't know if their mission is up to their primary federal regulator. Our role is to make sure that they tie their advances to home ownership, whether it's through MBS.
Do you have any reason to think that those liquidity injections were related to home ownership?
Well, we're doing a review of—
You would be the only one who believed that if that were true.
Excuse me?
You would be the only one who believed that if that were true. I'm not sure if anyone thinks that that was related to.
We'll find out the facts and put them in our report.
The banks that received the $30 billion were at imminent risk of failing. and ultimately did fail. And if the federal government had never intervened to ensure the deposits of SVB and Signature, those FHLB funds would have been permanently lost. Do you think it was responsible for the federal home loan banks to inject $30 billion into failing banks?
Well, the advances are covered by collateral, so the home loan banks don't lose funds at all, and 9 times out of 10, they're over-collateralized, so it's not a loss for the home loan banks.
Are you investigating whether these injections were related to housing finance, or?
We're taking a holistic view at everything that happened that weekend.
What's the timeline for the review?
September 30th.
Fox News had a headline that read, "New mortgage rules favor buyers with bad credit." The implication of the headline is that it disfavors buyers with good credit. According to an Urban Institute analysis of the new pricing matrix, those with the lowest credit scores and down payments would pay as much as 2.2% in LLPA fees, whereas those with the highest credit scores and down payments would pay nothing in LLPA fees. Does that strike you as a pricing model that, in the words of Fox News, favors buyers with bad credit?
Our new pricing grid in no way allows persons with high down payments and high credit scores to pay more than low. It just doesn't work that
Quite the
way.
opposite.
Yes, the opposite.
So the reporting on FHFA has not been fair and balanced.
Correct.
According to the Republican memo, the GSEs are private corporations chartered by the federal government with special benefits to help make homeownership more available and affordable for lower and middle-income Americans. Given that description, is it fair to say that the FHFA, as both a regulator and a conservator of GSEs, has a statutory obligation to break down barriers to affordable homeownership for lower-income Americans?
Yes,
And those barriers include high fees, correct?
many. And we actually have equitable housing finance plans that look at what the barriers are and provide suggestions on how to remove those barriers for underserved areas.
But reducing fees for lower-income, lower-wealth borrowers is not an act of radical redistribution on your part. It's a fulfillment of the mission conferred upon you by Congress. Is that a fair assessment?
Yes, and we did eliminate the upfront fees for first-time home buyers throughout the country. The way we're able to pay for that is through second and vacation. The fees charged on second and vacation homes, investor homes, are well more than the fees that were eliminated for first-time home buyers who are credit-worthy but struggling to have a down payment. In the enterprises affordable programs, the average credit score for many of these borrowers, I think for Fannie is 743, and for Freddie is 742. So we're just talking about credit-worthy people. They just don't have a down payment.
Thank you.
The gentleman yields. Gentleman from South Carolina, Mr. Timmons, is now recognized for 5 minutes.
Thank you, Mr. Chairman. The FHFA has been unusually aggressive in pursuing changes to the traditional role of title insurance in many mortgage transactions. Title insurance is an important tool to protect home buyers from damages or losses due to issues with the title. As it stands today, the title insurance company, not the home buyer, pays to resolve any title issues that arise in a real estate transaction. It surprised me to find out that Fannie Mae is preparing to develop a way to waive the title insurance requirement for loans purchased by the GSE. Director Thompson, no doubt you're aware of this reported pilot program that would allow Fannie Mae to effectively provide title insurance on its own mortgages. I join a good number of my colleagues on both sides of the aisle who are highly skeptical of this latest mission creep by one of the GSEs. Title insurance is a primary market activity that's well outside of Fannie Mae's mission and is the clearest example to date of Biden administration overreach. But as I dug deeper into this Fannie Mae pilot, I found some troubling aspects in the arrangement itself. Are you aware of the company partnering with Fannie Mae on this pilot?
That pilot has not been brought to my attention. We have a process for the enterprises to bring decisions to FHFA for decisioning, and I just have not seen that. I have read about it in the same way that you have.
Okay.
The FHFA has not made that decision.
So, well, they've partnered with a company named Doma Holdings. And are you aware that Doma is on the verge of bankruptcy? Just today, analysts again downgraded the outlook for the company further. Its stock has dropped from $10 to less than 30 cents since its initial public offering last year. And early investors have been selling off their shares, driving the share price decline and putting in question the long-term viability of this company. So here's a company on life support that the free market is putting out of business, and along comes Fannie Mae to throw it a lifeline. How could something like this happen? You know, then I look to see who sits on its board of directors, and I suspect you know what I found. Larry Summers, 71st Treasury Secretary under President Bill Clinton and Director of Obama's National Economic Council. So here's what I see. A company that's essentially out of money, but politically connected, receiving a no-bid contract to do a pilot program with Fannie Mae, which is overseen by your agency and the Biden administration. Is that a problem for you? Do you think that that raises red flags?
I have not seen that proposal come before me.
I'm just describing to you a contractual relationship. Does that cause problems? A company that's filing bankruptcy that is buddies with Biden getting a lifeline and getting a no-bid contract from your agency. Does that like generally raise a problem?
We did not give a no-bid contract.
It was not bid.
The pilot is not, whatever it is, has not been approved by FHFA, so it should not be undertaken until such approval is given.
It is being reported that Doma Holdings has the contract for the pilot. So is that not true?
I have not seen that proposal.
Okay, so let's just say that it is true because that's what's being reported. Is it a problem that a company that is on the verge of filing bankruptcy is receiving a no-bid contract, and it just so happens that Biden's buddies with the board of directors? Is that a problem? Would that be a problem if it's true? Let's put it that way.
I think it would be a problem for any company who is filing bankruptcy to have that issue. We look at safety and soundness. That doesn't sound safe or sound.
You're speaking my language. Thank you. Have you had any contact with Larry Summers regarding this? Have you had any contact with anybody in the Biden administration regarding the Doma Holdings?
I have not.
Okay, so it surprises you to know that all of these things have allegedly occurred. I guess, could you look into this and follow up to maybe give me more information about whether other companies were considered, how this all came about?
Absolutely.
Thank you so much. One final follow-up. Did FHFA consider that while nominally decreasing closing costs, a lack of title insurance for home buyers may leave consumers financially unprotected from false claims against their home for the life of their loan? Was that a variable that was factored into these decisions?
The variable that the enterprises care about is making sure that the lender reps that the home is free and clear and has no superior liens and that there's clear title. And the lender decides whether or not the title insurance is the mechanism. And I would say, and I've said this earlier, that Freddie Mac has allowed attorney opinion letters since 2008, but there haven't been many people that have used that.
I think sticking to the main mission and not trying to take on title insurance would be the best path forward for this. Mr. Chairman, thank you. I yield back.
The gentleman's time has expired. The gentlewoman from Texas, Ms. Garcia, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Director Thompson, for being here with us today. And let me just say that you've been a breath of fresh air as a witness, and I appreciate the time that you spent with us and your candor in answering all our questions. Last week, as has been noted by a couple of other of my colleagues, the Subcommittee on Housing and Insurance had a hearing on the Federal Housing Finance Agency's recent loan level price adjustment changes. As I learned from the witnesses in that hearing, the recent FHFA pricing changes has the potential to protect low and moderate income home buyers, a priority that I believe we should all share. Further, in that subcommittee hearing, I expressed my concerns surrounding the Republicans' lack of action in the housing space, especially because we were in the midst of a major housing crisis. As you said in your opening statement, simply put, there's just not enough homes, especially for first-time home buyers. This can be said in the Houston area that I represent. We were always considered a good place to find a home, that it would be affordable. But in the past decade, however, home prices have nearly doubled, and about half of the residents now spend more than 30% of their income on housing costs alone. Housing inventory in Houston has decreased, and the affordability gap has widened, especially for buyers and renters of color. Given our nation's worsening racial wealth and homeownership gaps, we know that people of color are more likely to be renters, and homeowners hold well over 40 times the median net worth of renters. When it comes to evictions, and this is also true in Houston, Black and Latina women are twice as likely to be evicted than their white counterparts, while people of color make up over 60% of the homeless population, which is more than their share of the total population. So, Director Thompson, the FHFA has a duty to dismantle inequities in housing and community development, and it is prohibited from discrimination, including through disparate treatment. How is FHFA ensuring that the operations and activities of the enterprises are affirmatively furthering fair housing opportunities for renters, including through tenant protections?
Sure, thank you. So FHFA has an Office of Fair Lending Oversight, and they examine both Fannie Mae and Freddie Mac to ensure that they're in compliance with the Fair Housing Act and that there isn't disparate treatment in any of the policies or applications of those policies. They are examiners, and they have reports of examination that they share with both enterprises. So that's one of the ways. The other way is, I mentioned earlier that we are going to issue a request for input to try to figure out what good tenant protections are, just in terms of during the pandemic, one of the protections that were instituted by Fannie and Freddie and any organization that had a federally backed mortgage was there needed to be notice of eviction, there needed to be notice of a rent increase, and just basic things. And most of these things are dealt with at the state and local level, but just making sure that people have an opportunity to understand what their rights are and make sure that they're enforced.
Thank you. One essential component in supporting homeownership for all Americans, allergy season. One essential component to supporting homeownership for all Americans is expanding access to credit and lending. Disparities remain in mortgage access, as only 4.7% of Freddie Mae and 4% of Freddie Mac backed mortgages for home purchases were from Black home buyers in 2021. And research from the Urban Institute suggests that there are more than 1 million mortgages are missing from the U.S. financial market each year, and disproportionate percentage of those are missed by borrowers of color. What can FHFA do to make sure that young Americans, low-income Americans, and Americans of color can purchase homes to build wealth for future generations?
Sure. So we noticed that same statistic, and one of the things that we're requiring the enterprises to do is put forth an equitable housing finance plan that identifies what the barriers are. They also have to identify solutions for these underserved communities. One of the barriers is just the financial literacy in terms of homeownership.
Gentlelady's time has expired. You may answer for the Director Thompson. You may answer for the record. The gentleman from South Carolina, Mr. Norman, is now recognized for 5 minutes.
Thank you, Ms. Thompson. Appreciate you coming today. Our constituents that I talk with back home are outraged about the government involvement, not just with the LLPA's adjustment, but just as a whole in the housing market. How important, where does, in your mind, in your role as director, where does the private sector come in?
Excuse me. Well,
do you support the private sector getting more involved that will enable the housing market, people to buy?
It would be nice to have a balance of private sector and government in the housing market as previously has existed.
When the LLPA was adjusted, the RFIs went out after it was raised. Who did that go to, and why wasn't it done prior to just going into effect?
So historically, every FHFA director, including myself, has made pricing changes, and we report on those changes every year. We send the reports to the Congress, and we publish them on our website. We also published the RFI because it was the misunderstanding that was spoken that high credit score borrowers were paying for low credit score borrowers.
No, let me ask you.
I was just gonna miss, if you could.
Let me just add, before you, let me ask you now, a higher, tell me if I'm right or wrong, a higher, that buyer with a higher base credit score, doesn't he pay an added fee that went up to subsidize those who may not have a?
The fee that was eliminated for first-time home buyers is paid for through second mortgages and vacation homes, investor properties, and.
Through a higher fee? Through a higher closing cost fee?
They have higher fees, and that's always been the case.
And that's where the money goes?
And that's where the money goes, yes.
Okay, so that is subsidizing those with the lower credit scores?
Yes.
The money's going somewhere?
Well, the Congress allowed us to get a lower return for certain mortgages.
I want to get my questions in, so but I think you've answered my question. Now, regulations are all over housing at every level. Rent controls, is this something that should be expanded by the federal government, in your opinion?
Our agency has not gotten involved.
I'm just, as director, what's your general opinion? Are rent controls a great thing?
We're actually issuing a request for input to the public to get information on rent controls and tenant protections to see what all stakeholders have to say. So,
okay. On appraisals, I've heard going from 3 to 2. Are the government agencies giving the appraisals or the credit reports varying information that they can include in the credit report and what they can't include?
The credit reporting agencies each have basic information, and some companies report to one, and like smaller community banks may report to one.
But it's left up to them. They don't have to, there's no guidance
It's up
that
to them.
they can, and I think it's good to put, if somebody pays their utility bill, pays their rent, but it's also good to know those who don't pay, the different groups. You agree with that?
Yes, I do.
So it ought to be all-inclusive, and they ought to make the decision.
It's opt-in if the tenant wants it, and I think the negative information is reported.
It has to be, it's part of the record.
So the positive information needs to be reported too, so if you have people paying their rent on time, that needs to be included.
Okay. What is your opinion on this with the title insurance, an attorney's opinion letter versus getting a full title?
The seller, the lender has to represent to Fannie and Freddie that they have clear title and that there's no superior lien to that property. So the lender can say, here's a title insurance policy. And in the case of Freddie Mac, who's been accepting attorney opinion letters since 2008, it'd be either or, not one is not supplanting the other.
Okay, and that's up to the agency to decide which ones they accept.
The lender.
Right, the lender decide. But let me say, we've had affordability issues come up. Have you ever asked those who are in the business why houses aren't affordable? Could it be that gas prices are sky high? Could it be at every level people are paying more for supplies? Could it be that all of it's brought on by this administration, which wasn't the prior case? Is that ever, I'll yield back. I'm out of time.
Gentleman from South Carolina yields back. Gentleman from North Carolina, Mr. Nichols, recognized for 5 minutes.
Thank you so much. Thank you, Director Thompson, for being with us here today. Over the weekend, I hosted a town hall in my district, and one of the top issues I heard about was the high cost of housing and the lack of affordable housing options. I've got one of the fastest growing congressional districts in the country, so this is a very important priority for my constituents. The high cost of housing is the single biggest squeeze on household budgets and a major drag on our economy. Access to safe and affordable housing is essential to the well-being of working families and individuals in North Carolina and throughout the country. As Vice Chair of the New Dems Affordable Housing Task Force, I'm working to lower housing costs and increase the supply of affordable housing. Unfortunately, if we're unable to find viable bipartisan pathways forward on addressing the debt ceiling, housing prices in my district would skyrocket. According to data compiled by the U.S. Census Bureau, defaulting could cause mortgage costs in North Carolina's 13th district to increase by $159,000. On a national scale, over 500,000 households nationwide could lose rental assistance, and mortgage rates could surpass 8%. Director Thompson, can you please share what defaulting on our debt would mean for our nation's housing finance market?
Sure. Thank you for the question. I think everything that you just said, extremely high mortgage rates would probably prevent or limit persons from purchasing a home. Also, making sure that the mortgage-backed securities investors know that they're going to get paid for the investment that they made. So if there are borrowers, they could be impacted by unemployment or issues related to employment, which could create delinquencies, and it would just not be a positive thing for the mortgage market.
Thank you. Defaulting on our debt could also send our economy spiraling into a recession, which I worry would have even broader impacts on housing costs for my constituents. How would a recession impact Fannie Mae and Freddie Mac, the government-sponsored enterprises created to help provide reliable and affordable access to homeownership?
So it would be prohibitive again because the interest rates would be probably so high that no one could afford a home. And I think Fannie Mae and Freddie Mac, in terms of protecting, borrowers who couldn't make their payments, they've got, $100 million that they've accumulated over the last 2 years that can cover losses, but it just would not be a good outcome, honestly.
Thanks. I want to shift gears here. My wife's an attorney and she handles real estate closings, so I certainly understand the importance of title insurance and the protection it provides to home buyers and lenders. I want to touch on this proposed pilot from Fannie Mae to become a de facto title insurance company. That really concerns me, what I've heard reported on that, as consumers could lose critical protections for their homes. I've heard your answers on this, from my other colleagues, but just generally speaking, Director Thompson, do you agree that protecting consumers and their homes should be a top priority, and that Fannie Mae, by replacing title insurance, probably is not the best way to do that?
So yes, I do think that protecting consumers is critically important, especially on the largest asset purchase they'll make. But I do not believe that Fannie Mae is going to be in the primary market or the activities in the primary market at all. Again, the title insurance or attorney opinion letters are acceptable, and Freddie Mac only on the AOLs, and again, that's been since 2008. But those are really to protect Fannie and Freddie from, the seller has to represent that they've got clear title and that there are no superior liens. And so the lender can decide what's acceptable.
Thanks. Will you commit to conducting an open process with public input for any new programs under consideration as called for by the prior approval for enterprise products rule?
So we have a new products rule that we finalized in December, and we've been working out how that new products rule will work both internally at FHFA and at Fannie and Freddie. And we are committed to making sure that pilots are public and people know there's more transparency in what's going on at Fannie and Freddie.
Thank you. Mr. Chairman, I yield back.
Gentleman yields back. Gentleman from Wisconsin, Mr. Fitzgerald, is now recognized for 5 minutes.
Thank you, Mr. Chair. Director, thanks for being here. When Fannie and Freddie were taken into conservatorship in 2008, Treasury received warrants that give it the right to buy common stock in each of the GSEs equal to 79%, I guess, of the total outstanding shares. And those warrants expire in September of 2028. And in August of 2020, the Congressional Budget Office issued a report that estimated Treasury could not only receive $190 billion for its senior preferred shares, in addition to the $110 billion from exercising its warrants in the GSEs. So while the conservatorship has gone on for far too long, I'm concerned that given the Biden administration's record to date, that these warrants could be used as kind of a slush fund or piggy bank to advance any of the partisan housing agenda. And do you have any comment on that, or is that something that you guys have identified and are worried about at all?
Well, thank you for the question, and I think, these conversations need to take place with Treasury in terms of what their plans are for the warrants since they own them, and we have not had those conversations with them.
So no conversations with Secretary Yellen at all about this topic so far?
Secretary Yellen is on our Oversight Board, and we talk about all things related to FHFA and their activities. But on this specific topic of the warrants, we have not had that conversation.
Okay, very good. The Securities and Exchange Commission recently reproposed the conflicts of interest rule, which could unintentionally impair the ability of private mortgage insurers from procuring reinsurance through the capital markets. As a director, obviously you have firsthand knowledge that the private MI companies are subject to stringent regulation and requirements at both state and federal levels from the GSE, and that they use reinsurance through the capital markets to manage risk and capital. By taking a first loss position, private mortgage insurances reduce risks for the GSEs, protecting taxpayers. Can you tell me if FHFA is currently working with the SEC on the final rule to ensure it does not really have any harm, I guess, on the mortgage insurance?
So I'm not available to talk, I can't talk about open rules, but we have, the enterprises, I should say, have provided comments on the impact of this particular rule on their credit risk transfer activities.
Okay. And with the last couple minutes I have here, I just thought that maybe, well, let me just kind of talk about, you justified the LLPA changes partially by saying that they are needed to protect the GSE's capital buffer from losses. However, GSEs would have more capital if the FHFA did not lower fees for riskier borrowers and use the capital from less risky borrowers to make up for it. But the larger problem with these fees is that they act as kind of a political hedge against the Fed's interest rate hikes. Do you want to, would you comment on that, or do you agree with that?
I think what I think is true is that the changes that we made in the pricing grid actually help with safety and soundness because they're calibrated to the capital rule that's in effect, and they also cover some of the administrative costs that the enterprises have. That's what the guarantee fee does, and the upfront fees are part of that. And so I do think that at the end of the day, the risk-based fees that we have in place are doing the two jobs of, one, safety and soundness by building capital, and two, we were able to offset the fees for first-time home buyers throughout the country by the fees that are charged for the second and vacation homes and investment properties. And so we were able to figure out a way to achieve the dual mandate that the FHFA has in overseeing Fannie and Freddie by updating these out-of-date pricing grids.
I'm going to run out of time, but maybe you could still answer one more question. And it's more a thought that continues to come up in financial services. There is this bracket or group of adults between 25 and 35 right now that have been completely froze out of the housing market. And I'm wondering how you view
Gentleman's
that or
time
if
has
you look at that.
expired. If you'd submit that question in writing, I'm sure the director will respond promptly.
Thank you. You bet.
The gentlewoman from Colorado, Ms. Patterson, is recognized for 5 minutes.
Thank you, Mr. Chairman. Director Thompson, thank you so much for being here. You have a difficult job of making very complicated decisions, and I appreciate the time that you spent with me walking me through exactly why you all made the changes, and I think that you've done a good job in communicating the impacts of that and the intention, and unfortunately not every American can sit with you and hear that, and so I think that that's the difficulty with politics, is taking these complicated things and trying to create simple messages. So thank you for your work, and to everybody in your agency for the work you do every day. The FHFA serves a critical role in ensuring that Americans with different incomes, levels of personal wealth and credit scores are able to purchase homes. And we all know that we're in the midst of a historic housing crisis, and the dream of home ownership remains out of reach for many. Home prices in Colorado have skyrocketed throughout the last 20 years, but especially during the pandemic when people were able to work remotely and come to a place that they've always wanted to live. Some communities in my district have seen their home values increase threefold in just a few years and are being forced to leave the communities that they grew up in. The increase in the cost of housing has also made it difficult for our small businesses to hire and retain workers, and our public servants are far too often unable to stay and work in these communities. One thing that this committee must address is how we can help incentivize building more housing. We know we have a supply issue. There are numerous reasons why, but one significant contributor is our failure for decades to provide a legal pathway for people who want to work in the U.S. to do so. Our workforce shortage and inability to address our failed immigration system has crippled our economic growth and has significantly increased the cost of building homes and stalled our progress in meeting our housing needs. We've also seen the unfortunate impact of failed tax policies in the U.S. that have increased the inequities in this country and have made it harder for regular people like me to have a chance to get ahead and build a better life. We're seeing the impacts of these policies in every area, but especially in housing. Homelessness is on the rise in every community. Middle-class families are having difficulty getting ahead to buy their first home. And in rural parts of my district, the housing supply being bought up for vacation homes, while people who have lived there their entire lives are being forced out. Since I know you can't solve our failed tax policies and immigration system, you do oversee the financing of most housing. And I'd like to know what programs and incentives you're currently providing to help low and middle income individuals buy a home that our constituents should know about, and what Congress should consider to reduce the likelihood of houses being bought up for third, fourth, and fifth homes. Also, what can we do to support our public servants in buying homes so they can stay in the communities that depend on their services?
Great, thank you. So we did reduce or eliminate the upfront fee for first-time home buyers for the reasons that you've articulated. The housing supply shortage is very real. There aren't enough houses, and people who live in, work in communities can't afford to live there. And so we eliminated the fee for mostly workforce housing people and first responders, our policemen and firefighters and teachers, as well as first-time homebuyers, people just out of college or people that have been living in apartments for a while. They just can't afford these down payments, and so they are required by law to have the mortgage insurance, which is added to their fee, which makes our pricing grids make sense from a risk-based perspective. But we really believe that we're able to eliminate these fees for first-time homebuyers because people are getting, second and third homes, and those fees kind of offset the fees that were eliminated. And so we just believe that homeownership is important. It's important to communities around this country, and whatever we can do to be helpful in that way, in a safe and sound manner, is what we're going to do.
Well, thank you. We have very little time left, but one of the problems that I constantly see is we have great ideas, great programs at every level of government, but nobody knows about it. Do you have an outreach program, and are there things that we can do in Congress to support your work?
I think the enterprises have outreach programs, but I really do wish the message about the first-time home buyers would reverberate throughout the country so that people would know that the upfront fees for first-time home buyers are eliminated.
The gentleman from Pennsylvania, Mr. Muser, is recognized for 5 minutes.
Thank you, Mr. Chairman. Thank you, Director, for being with us. So there is, as we all know, a significant decrease in housing affordability in our country from supply issues, largely due to inflation, building costs, rising interest rates. In Pennsylvania, the price appreciation is nearly 50% just over the last several years. Hopefully, the administration is not planning on making this worse with new regulations and unnecessary government meddling. So the government entities such as Fannie Mae, Freddie Mac, FHLB system, HUD, VA, USDA represent a large share of the mortgage loan market. There obviously should be a coordinated approach to housing policy across the government to ensure the federal programs do not compete for market share. In the past, when FHA has reduced rates and incentivized borrowers to move to the FHA, which is supposed to be a safety net and not first choice. Can you describe briefly how you coordinate with other federal agencies to ensure there is no duplication?
Of course, and we have quarterly meetings with the other government agencies. We call it the housing govies, but we meet every quarter to talk about the policies that we're each undertaking so that we have this has been going on for many, many years. We meet regularly. The Secretary of HUD is on our oversight board as well as the Secretary of the Treasury. We meet every quarter to have conversations about FHFA policies, and we also have our teams work together on issues that affect housing in this country. There's lots of communication.
Sure. Okay. When the FHA announced a premium cut of 30 basis points in February on the premium charge to mortgage borrowers, did the FHA consult with you on the premium reduction announced in February?
They did not consult with us. Certainly the reduction in mortgage insurance premium had been widely speculated. They did let us know that they were going to move forward on that.
So what effect do you think it had on the private mortgage insurance market?
Well, the FHA has a different market than FHFA. I get this question all the time, and we've looked at the enterprises acquisitions, and again, for the affordable programs, the credit score for most of the Fannie and Freddie borrowers is over 740. That's not the case for many borrowers who have FHA-backed loans or VA-backed loans.
Do you feel it was minimal effect?
Excuse me?
Okay, no, so you feel it was a minimal effect since it was two different marketplaces, more or less, as you stated. Okay. Do you, in the questioning with Mr. Cleaver and Mr. Barr, you did not mention the liquidity mission of FHLB. You said that you were also working on a report to provide new guidance for FHL banks. Do you agree that providing liquidity to the members of FHLB is a primary mission of the Federal Home Loan Bank?
That's in the statute, yes.
Yeah, okay. Now, regarding the guidance, can you offer any details on what you might be planning?
So we did a study to figure out what was working and what was not. We had 17 listening sessions around the country and 3 days of sessions here in Washington. And one of the areas for improvement were the Home Loan Bank's contributions to affordable housing programs, and that was throughout the country. And so we'll be culminating our report with what they've done correctly, which is a lot, and as evidenced through the most recent bank failures, and then some areas for improvement, some things we can do and some things we'll ask the Congress to do.
Was the action of moving the fees higher for those with better credit, if you will, versus those with lower credit, did you get much feedback related to that?
Sure. Well, I would say that under no circumstance do borrowers with high credit and high down payments pay more than borrowers with low credit and low down payments. And what we did was we took an outdated pricing grid that actually was so outdated that it overcharged a lot of the borrowers with the low credit, and it overcharged other borrowers. And so we took the current capital rule, which really looks at, on a loan-by-loan basis, the risk associated with each loan, and we calibrated the pricing grids to accommodate the new capital rule.
A lot of people
I'd be happy to walk everybody through
confusing
that.
thing to do, right? That it was very controversial that those with good credit would be punished and those with not so would be rewarded. I yield back, Mr. Chairman.
Thank the gentleman from Pennsylvania. The gentlewoman from Massachusetts, Ms. Presley, is now recognized for 5 minutes.
Thank you, Director Thompson, for joining us and for what you do each and every day. I represent the Massachusetts 7th Congressional District. There was a report, The Color of Wealth, put out by the Federal Reserve of Boston that states that the average wealth for a Black Bostonian family is $8. and that of a white family is $247,500. I believe that has everything to do with home ownership. In July, when you last came before our committee, I asked if your agency, the FHFA, had considered how eliminating loan level price adjustments could increase equitable access to home ownership. Following that hearing, FHFA enacted reforms, including the elimination of upfront fees for low to moderate income first-time homebuyers. I really applaud your leadership in making these pricing changes. These are important steps in improving equity in the housing market. I still believe that the FHFA needs to go further and fully eliminate these harmful fees which place home ownership out of reach for everyday people, especially Black, brown, and low-income home buyers. Many stakeholders, including consumer and housing groups, agree that it is time to get rid of these fees. Have you looked into the feasibility and impact of eliminating LLPAs altogether?
Sure. We mentioned that we have just recently issued a request for input that talks about this issue. And one of the questions that we're asking is, should LLPAs be eliminated? We're asking, should the pricing grid be tied to the capital framework? So there are a host of issues that we're trying to get stakeholder input on. I'd be happy to keep you updated on our progress.
I'd certainly welcome that. Thank you. This LLPA framework, it does disproportionately impact consumers of color. And so I'm glad that you're looking at this so that we can eliminate these structural barriers to affordable housing. Mr. Chair, I ask unanimous consent to enter a 2022 article by WBUR titled "Black and Hispanic People Are More Likely to Be Denied Mortgage Loans in Boston." I'd like to enter this into the record.
Without objection.
Director Thompson, in this report, WBUR found that 3,501 applications for loans to purchase homes were denied in Boston between 2015 and 2020. For white applicants, the denial rate was approximately 5%, but for Black and Latinx applicants, the denial rates were 15.3% and 12.7%, respectively. This is a modern-day redlining. In your view, what are the biggest barriers for lower-income borrowers and borrowers of color when applying for conventional mortgages?
So, great question. We have found that many underserved borrowers, particularly in communities of color, are renters, and some of the positive rental payments don't get counted, and so they end up being credit invisible or they have limited credit. And so to the extent that you report on positive rental payments, it really helps people build their credit in a way that is reflective of their ability to and willingness to repay. And so those are some of the changes that both Fannie Mae and Freddie Mac have made in their underwriting mechanism. And when we update the credit score models, it will include things like, rental payments and utility payments or streaming payments, just things that weren't thought about 30 years ago. So this is really something that's very important. But the rental payment impacts everybody across the country because people were not getting credit for positive rental payments.
That's right. That's right. And additionally, hikes in rental costs in my district, the Massachusetts 7th, and across the country have put many low-income families really in dire straits. In Boston, we've had rents that have risen by nearly 20% in some neighborhoods. Director Thompson, what can the FHFA do to protect tenants from these egregious rent hikes we are seeing, specifically in properties with federally backed mortgages?
So we do a lot of investor and stakeholder outreach, and we're getting ready to, before the end of this month, issue a request for input on tenant protections. This has come up a number of times, and we want to hear from not just the people that are building these houses, but we want to hear from tenants as well. What can we do to be more proactive and fair and safe and sound in this area? So we are looking forward to getting comments from our request for input.
Thank you very much, Director. And I do, it's really unconscionable that this committee under Republican majority has declined to prioritize housing and homelessness in the 118th Congress. Housing affordability is the #1 issue.
Gentlewoman's time has expired. The gentleman from Wisconsin, Mr. Stile, recognized for 5 minutes.
Very good. Thank you, Mr. Chairman. Director Thompson, thank you for being here. Home prices are skyrocketing because regulations and supply chain disruptions have made it too difficult to build new homes in many ways. Interest rates have exploded because Washington went on a spending spree and pretended the effects would only be temporary and transitory. Homeownership's getting even further out of reach for countless Americans. Meanwhile, the FHFA is pushing changes that would penalize responsible home buyers and inject more risk into the housing finance system. I'm concerned it's the wrong approach. Earlier this year, the FHFA approved changes to their pricing system. You've discussed those changes today. They're complex, but I think it's clear that it would lead to many responsible borrowers paying more, and ultimately, those with lower credit scores and smaller down payments paying less. You've noted some of your rationale for doing that. I don't know that I agree with the approach that you've taken. It seems broadly unfair. The FHFA is also allowing GSEs to expand the use of attorney opinion letters instead of traditional title insurance, and I'm concerned that maybe putting borrowers at risk in the name of saving a few dollars up front. And your agency is also considering a title insurance waiver pilot, and I'm concerned that would increase the risk for homeowners. I want to encourage you to review the course that you've set. And I think broadly, we do need to make sure that our GSEs are safe, sound, and well capitalized and support responsible home ownership. The American people face a lot of challenges in today's high inflation, high interest rate environment. We need solutions that work for them. Let me shift gears slightly and dive into a pair of questions that I think are pretty relevant for us to get our heads wrapped around. First, I want to get in the weeds here, if I can, into the 3 credit reports to 2, shifting from 3 credit reports to 2, that it could have, and will it have unintended consequences? And so as we look at this move from the tri-merge standard to a bi-merge, under the bi-merge standard, do you feel that there might be an incentive for brokers to cherry pick the 2 highest credit scores for a prospective borrower? And how would the FHFA prevent any gaming in the system under a bi-merge standard?
So moving from 3 to 2, I think one of the requirements we have is that if the lender chooses 3, if they don't like the 2, that if they choose 3, they have to use all 3. But we're still working on that process. But I did want to, if I could, just make a comment about something that you said earlier. I just want to make sure that for the record that we've done a lot of analysis, and there's borrowers with high credit scores are not subsidizing borrowers with low credit scores. We are providing an elimination of fees for first-time home buyers across the country in rural areas, manufactured housing, and that is being paid for by people who are buying second and third and vacation homes and investor homes, and that money well offsets the fee elimination. And so it is.
Is the fee increasing for high credit scored individuals?
The fee is calibrated, the pricing grid is calibrated to the capital requirements for individual loans. And we went through a public notice and comment period on that. It's very public, and you can, we can look at that.
No, understood, but is the fee increasing for high credit score individuals?
The fee is changing for not all high credit and not all low. There's no universal. It's just increasing for high credit score individuals. In some cases, it's 0, no change whatsoever.
In some cases, is it increasing?
In some cases, it's an increase, and in some cases, it's a decrease.
Okay.
But at the end of the day, it's no borrower with a low down payment and a low credit score is going to pay less than, they're going to pay more on average than a high credit score borrower. That's just the way the calibration works.
Understood, but in the delta, in the change from the proposal you put forward.
Well, you would have to believe that the original grid was accurate, and the original grid was outdated. It wasn't calibrated to any of the capital requirements that the enterprises were using, not the one that was in place in 2017 and 2018, and not this one. So we updated it to make the enterprises more safe and sound, more viable, and so that they could accumulate the appropriate amount of capital for the risk that they're taking. So they wouldn't have to be on the backs of the taxpayers.
I appreciate being here. I'll follow up in writing on the bi-merge because we ran out of time for it. Mr. Chairman, I yield back.
I thank the gentleman. The gentlewoman from New York, Ms. Velasquez, is now recognized for 5 minutes.
Thank you, Mr. Chairman, and thank you, Ms. Director Thompson, for being here. You know, if the Republicans are so concerned about interest rate and mortgage payments being so high, what would it happen if there is a default, a debt default? Ms. Thompson?
Yeah, so I think the mortgage interest rates would be really high, and it would be likely more preventative from borrowers getting home ownership. And then I'm sure that mortgage-backed securities investors would want to make sure that they got paid.
One economist today described it as a calamity. So, Director Thompson, Senator Van Hollen and I recently wrote to you and the other regulators charged with writing the incentive-based compensation rules under Section 956 of Dodd-Frank. So thank you for your response. Last week, some of the other regulators told me in this committee that the 6 agencies have met since the collapse of Silicon Valley Bank, and a notice of proposed rulemaking could be out by the end of the year. Do you agree with what they said? And do you agree with this timeline for a notice of proposed rulemaking?
Thank you for the question. I was on the call where we agreed to move forward with the rule and to try to have it out by the end of the year.
Thank you. And Director Thompson, as you know, residential co-ops are an important part of our housing stock in New York City. Can you explain the programs the GSEs have in place for affordable housing investment in co-ops and the options for refinancing? How is the FHFA working to expand programs for residential co-ops?
So the enterprises are allowed to buy co-ops, and again, they purchase the loans that are made, and there are requirements for purchasing those co-ops. We have not, I don't know the specifics on if there are issues with that or not, but I do know that those are eligible products for both enterprises to purchase.
And in terms of the options for refinancing?
And the option for refinancing is there as well.
So, Director Thompson, there has been a lot of misinformation and mischaracterization by Fox News to the changes the FHFA was making to its pricing structure. So could you please explain how these changes were intended to help home buyers across the country in all communities? And maybe tonight, Fox News will air your response.
Sure, thank you. So the changes were made, one, to update the outdated pricing grids that had not been updated in almost 10 years. Two, the changes were made to really help first-time home buyers who cannot afford a huge down payment on a home to have them have home ownership more affordable. And this is across the country. Certainly this is for borrowers who have area median incomes of 100 and 120 in high-cost areas. But we really thought it was important for the workforce, for policemen and firemen and teachers, and just people to be able to live where they worked. And we wanted to do what we could to provide affordability. And again, we're paying for that with the fees that are generated from second homes, investor homes, and vacation homes. And so that was the second reason. The third reason was to build capital so that the enterprises could meet their capital requirements and be in a position to absorb more losses. The enterprises are woefully undercapitalized, and this was a good way to balance safety and soundness and responsible access to credit.
Are you listening, Fox News? I yield back, Mr. Chairman.
I thank the gentlewoman. Recognize the gentlewoman from California, Ms. Kim, is now recognized for 5 minutes.
Director Thompson, thanks for being with us today.
As you may know, California has suffered from a chronic home affordability for years. Last year, Orange County, my district, surpassed the median selling home prices going over $1 million. To make matters worse, California has the highest rate of poverty of any state with 13.2%. So in California, we have a mismatch in the housing market with low supply, the highest home prices in the country, and a large segment of the population unable to afford a home. One of the solutions to California's housing access and affordability problems is found in your testimony. The move to newer, more modern credit scoring models you are undertaking will score 12.5% more for my constituents in California 40th District. And of these newly scorable folks, 41% or 26,000 of them are near prime with a score above 620. So can you outline the benefits of including rental payments, utility payments, and cell phone payments in mortgage credit scores?
Sure. So I think one of the tenets of good credit is somebody's ability to pay and their willingness to pay. And if you have people that are making a living and they're making their payments every single month on time, but they just can't afford a low down payment, we think that their ability to pay and their willingness to pay, as demonstrated by their continuous payments of rent every single month, is really important and ought to be considered in their credit score. And utilities, I mean, you certainly need water and electric. And so if people are paying their bills on time, just because somebody has low wealth doesn't mean they have bad credit. And to the extent they are able to and willing to pay, then that ought to be taken into consideration.
I couldn't agree with you more. I do have a bill to do just that. So thank you. That will definitely help Californians achieve the American dream of home ownership. So please keep me updated on your efforts as well. The topic of the GSEs venturing into title insurance has come up a lot recently, and there are some major concerns amongst my colleagues about these endeavors. Whether it's the reported Fannie Mae title waiver pilot or the promotion of unregulated title insurance alternatives onto the low-income borrowers, I too am worried that the FHFA may be pushing alternative products and workarounds that don't effectively protect home buyers, lenders, or GSEs themselves. So I would like to ask you and encourage you to go back and revisit the rationale behind FHFA pushing the use of unregulated title insurance on low-income borrowers in general. But most immediately, can you confirm that these risky unregulated title alternatives are not being pushed in Southern California, where I'm from and where my constituents are, or in other seller-paid geographics across the United States?
Yes, so first let me confirm that it is our goal to protect borrowers and to protect the enterprises. And FHFA is not pushing any unregulated entities. I think the title insurance is a requirement, again, by the lenders for the borrower for the lender to prove that there's clear title and that there's no superior lien. And since 2008, attorney opinion letters are an option for certain borrowers under certain circumstances, but nobody's pushing that.
Well, thank you for the clarification. In the interest of time, I just want to continue. But I want to say that we need to ensure that these pilot programs don't undermine the safe and soundness goal of FHFA. Now, I commend you for conducting a robust review of GSE's NPL and RPL loan sale programs. However, given that these programs reduce the risk to the GSEs and the taxpayers and help achieve more favorable outcomes for borrowers and local communities, I encourage you to restart these programs as soon as possible, but I understand these programs have come to a stop. So, and these programs are important to help de-risk programs, the GSEs and the taxpayers. So would you agree that we need to restart these
We
programs?
wanted to make two changes. One, we wanted to update the benchmarks because they were old, and two, we wanted to make sure that all the lost mid programs that the enterprises have are included in the waterfall.
The gentlewoman's time has expired.
Thank you, I yield back.
The gentleman from New York, Mr. Garbino, is recognized for 5 minutes.
Thank you, Chairman. You were just discussing a little about title insurance with my colleague. Last week, we had the Housing and Insurance Subcommittee. I discussed the FHFA's proposal about waiving title insurance requirements and acting essentially as the title insurer to a lending organization. Mr. DeMarco, who was one of your predecessors, said, quote, "Title insurance is a primary market function, and frankly, the GSEs simply do not belong in the primary market." He also went on to say that it was disturbing to think that Fannie Mae or Freddie Mac might displace title insurance by taking on the insurance itself. Would you agree with Mr. DeMarco that Fannie and Freddie have no place offering their own title insurance products?
Well, I have not, FHFA is not pushing that, and I have not seen that proposal. And we would have to evaluate anything on the merits of safety and soundness to the enterprises and to borrowers.
So you don't think that, you brought up attorney opinion letters. You don't think that, well, what do you think about the proposal? Would you agree with the proposal if Fannie and Freddie wanted to waive title insurance requirements?
I would have to see if that was a safe and sound decision or proposal. I would have to evaluate that on the merits, and I just haven't seen it.
I mean, I wouldn't think it would be safe and sound. I was a practicing attorney. I did house closings all the time. I worked with title insurance companies. We had title closers at closings, and thank God for them at some of those closings because they saved a lot of homeowners a lot of grief by going through the title insurance policy. So I don't think it would be a sound proposal, and I hope if anything does come forward where Fannie and Freddie would waive those insurance requirements, I would hope you would object to it because there's a reason private lenders require title insurance now. There's protection there. And when homeowners purchase their homes, that's usually the biggest asset they're going to buy. And it's one thing to have title insurance that protects the lender. It's also another thing to have title insurance that protects the homeowner. So I think any sort of waiver of title insurance requirements by the GSEs would be a huge mistake and would end up hurting consumers. I want to move on to, and one of my other colleagues used this word, but the administration has tasked the FHFA with looking into enhancing tenant protections and addressing egregious rent increases in the enterprise multifamily programs. Director Thompson, what do you consider to be an egregious rent increase, and do you have concerns that any kind of rent control in enterprise programs would disincentivize multifamily borrowers and significantly impact the supply of affordable housing?
So one of the things that we're doing before the end of this month is issuing a request for input on this very topic. So I'd love to keep you informed on the information we're getting from all stakeholders on this really important issue.
Okay, so you don't have any, you're requesting information. I would have to say, one thing we've seen in New York, which has rent stabilization laws and limits deductions of investments from people who have, landlords who have affordable or offer affordable housing, when you limit rent increases, when you limit deductions that can be taken from investments, capital investments into upgrading these apartments, you see landlords then they walk away. They either say, well, we're not going to build any new apartment buildings, or we're not going to continue to invest in these because I can't recoup the money that I'm investing in. So the renters, the low-income renters who are in these affordable housings, they face, they're the ones who are hurt. So I think when you're requesting this information, again, to pay attention and to focus on what the actual effect is and on these low-income renters. And I think we have a perfect example of how they're harmed when you look at what's been going on in New York City, where we already have rent stabilization laws and limits on deductions on investment and how to recoup capital improvements. Last question, because I'm running out of time. I've heard significant concerns from market participants that GSE's proposed timeline, yeah, that's not it. We've heard a lot today about increasing access to homeownership, an issue that has especially hit home for me. I continually hear about the concern from my constituents. According to the latest stats, New York has the lowest percentage of homeowners in the nation, under 55%. One way to reduce prices in the housing space could be through a new model of providing mortgage insurance designed to create more flexibility in pricing for borrowers by utilizing new streamlined, highlight capitalized approach. All right, I'll submit this for the record. Sorry, I'll yield back.
The gentleman from New York will submit that question for a prompt answer. And now we turn to the gentleman from New York, also Mr. Lawler, for 5 minutes.
Thank you, Mr. Chairman. Director Thompson, you said a few minutes ago that the changes that you have made to mortgage pricing were designed to lower the risk profiles of the GSEs. I want to focus on the LLPA changes you announced in October, where you decided to eliminate LLPAs altogether on certain borrowers, like first-time homeowners, which you paid for with increased fees on second and vacation homes. That's obviously a policy choice, and we can argue whether it's good or bad. But my question is on the impact of this change from a risk management standpoint. Since first-time homebuyers have presumably never owned a home before, there is no history of how they will do in repaying the largest loan they have ever taken in their lives. And yet you lowered the risk-based pricing fees on those loans to zero. Can you tell us how that decision lowers the risk profiles of the GSEs here?
Sure. So as you know, borrowers that have very low down payments are required to have credit enhancement by law, so the enterprises cannot buy a loan that has a loan-to-value ratio of greater than 80% unless it has credit enhancement. That credit enhancement takes the form of mortgage insurance, and to the extent that borrowers with low loan-to-value ratios default, the mortgage insurance stands in front of and takes the first loss position, so it reduces losses to the enterprises. The mortgage insurance companies are capitalized, they've got liquidity, and at the end of the day, we're transferring the first loss credit risk to the private sector, which it helps protect the enterprises. So from a risk-based perspective, the cost of that premium gets included in the pricing. Even though we eliminate the upfront fees, it's a very small portion of the total fees that low credit risk, low down payment borrowers pay, and they pay more than any other borrower. And if you look on the final grid that shows what the total amount of payment that borrowers pay, it is risk-based, and there's absolutely no case where low credit score and low down payment borrowers pay less than someone with a high credit score and high borrower. And what I get nervous about is people hearing that, oh, I don't have to have a good credit score to get a house, and then they're going to go to the bank and get sorely disappointed. And so I want to make sure that people understand that you have to, continue to pay your bills. We're talking about credit-worthy borrowers. And again, in the enterprise's flagship programs that are their affordable programs, the credit scores are in over 740. These are people that make their payments, they're credit worthy, but they just don't have enough money for a down payment. And the enterprises are protected through the mortgage insurance.
My colleagues, Ms. Wagner and Mr. Davidson, discussed with you the issues that we have a perceived lack of transparency and stakeholder input that the rollout of the new pricing framework has brought up. Again, while the recent formal RFI is a nice first step, the American people need to see more. And given all the attention on the recent pricing changes and some of the backlash that has resulted, are there other specific ways that FHFA can increase transparency for actions like this in the future?
Sure. So we specifically are intentional about providing public information on pricing. Every year we submit a report to the Congress, and we also publish it on our website that talks about what the pricing is, how it's changed year over year, and it goes into detail on small lenders, larger lenders, loan-to-value ratios. And so in the 2022 report that we published, we actually articulated that we were going to update the pricing grids, and we also, in the scorecards that we published that define what we expect the enterprises to do both in 2022 and 2023, we let the public know that we were making these pricing changes. What was interesting to me was that many people didn't understand the mortgage insurance component, and so we thought that we would take this opportunity to explain what we did by issuing the RFI and then get input to answer questions like, should we even have LLPAs? Should we include mortgage insurance or not? Should we tie the pricing to capital? So we're trying to get as much input as we can.
Thank you. Gentleman's time has expired. Recognize the gentleman from Florida, Mr. Donalds, and we have votes called on the floor, and we will continue questioning until there are 200 votes outstanding. And so I now recognize Mr. Donalds of Florida for 5 minutes.
Thank you, Mr. Chairman. Director Thompson, thanks for being here. Real quick, I'm pleased to see that FHFA announced rescission of the debt-to-income upfront fee proposal. In my view, the decision came after significant stakeholder feedback and congressional oversight. Can you speak about the specific issues inherent with the debt-to-income proposal from both lenders and borrowers that were raised throughout the process?
Sure. So when we made the announcement, and there is a debt-to-income capital requirement in the capital rule, lenders said, they called and they said, this is real, we're having operational challenges implementing this. And I personally went to and visited lenders, credit unions, I went to banks, I talked to heads of organizations, and they walked us through the process. And they said, especially for first-time home buyers, it was difficult to exactly pinpoint what the debt-to-income ratio was at a point in time. Many times people forget, pieces of information, whether it's expense or whether it's additional income that has to get added into the calculation. And what they were nervous about was this notion called bait and switch, that we start out with pricing for a loan with one set of information, they get additional information, and then the pricing would change if it moved the debt-to-income ratio up to 40%. And so there was lots of confusion about it, and we postponed that implementation through August, and then after getting lots of information from talking to stakeholders, we rescinded it.
Director, let me ask you a question. Do you guys have any plans on trying to bring this back?
No, we do not.
No, so okay, all right. I just want to make sure we clarify that. Sometimes I find in this town, ideas bubble up, then they go away, then they bubble up again in the future. So I think it's important to state that. One other thing I want to talk on real briefly is I have some strong concerns about the reported title insurance pilot program at Fannie, namely the opaque process with which this program is being developed and how it would work in practice. A spokesperson from Fannie stated in response to recent reporting on the title pilot that the agency was still in the research phase. Can you describe the stakeholders and data FHFA is utilizing and collaborating with as it conducts research on this potential action?
Yeah, FHFA is not conducting research. FHFA evaluates proposals from Fannie Mae and Freddie Mac. I have not seen that proposal because a pilot would have to be approved by FHFA. And we also put in place a new products rule, and we have all of the pilots that both Fannie and Freddie are engaged in. That proposal has not come to FHFA for approval.
Okay. Director, last question. Are you concerned about the current size of the GSEs? And to a second degree, do you guys have any concern about potential loosening of underwriting standards?
So to answer your question, I'm concerned about the enterprises building capital so that they can cover their losses. The size, the enterprises have very low delinquencies right now. The loan-to-value or the mark-to-market loan-to-value on the book of the enterprises is the best it's ever been. But I am concerned about making sure that they build capital so they don't have to default to getting taxpayer support. So that's my number one concern. And my second concern, 1A and 1B, is making sure that they fulfill their responsibility to provide liquidity throughout the United States to homeowners everywhere, not leaving anybody out, but making sure that creditworthy borrowers can get access to first-time homeownership.
Well, I will say in closing, I share a portion of your concern. And this is as a former banker who watched the residential side from the commercial side. I would say that with respect to the GSEs, being able to be supportive of the mortgage markets to a degree is a goal that I think is optimal, but it may not always be realistic. But I think that the key concern is always going to have to be credit quality, because credit quality is the thing that's actually going to protect taxpayers in the long run. With that, I yield back.
Gentleman yields back. The gentleman from Iowa, Mr. Nunn, is recognized for 5 minutes.
Thank you, Mr. Chairman Hill. Very much appreciate it. Director Thompson, thank you so much for spending some time with us today. As a guy here from the Midwest, I think we want to make sure that both our first-time home buyers have an incredible experience and do this the right way, and that ultimately the taxpayers are not on the hook for when things don't work out the right way. And for those of folks watching back home in Iowa today, your organization, the FHFA, plays a unique role in how mortgage markets function. In fact, you're the primary regulator for our GSEs, Fannie and Freddie. Over half of the mortgages on the market owned or guaranteed by those government agencies. That's more than 50% of where we are here. And you are the primary mission to regulate these GSEs. By design, the FHFA is intended to be an independent agency, free from agenda or political pressure, whether it be from Congress or from the White House. Now, as we've heard here today, some have argued that the FHFA is pushing forward the administration's equitable housing finance plans, but that you're doing it while displacing potentially private capital. Additionally, your agency simply announced significant changes to long-held standards via a press report or a periodic report disregarding any formal notice or comment period. That is an issue that is concerning. Last October, the FHFA made two important announcements related to credit scores and home ownership. First, adding Vantage 4.0 seems to make a lot of sense, and that's an area where we would agree with you. These new models help score an additional 11% of people in my district, and nearly half of those folks score near prime or higher than 620. So my question, Director, is what's the timeline for this project that you're working on, and can you commit to being communicative, not just with my office, but with us here in Congress, on how that process is going?
Sure, so thank you. It's going to be a multi-year effort to update credit scores, because credit scores are used not just for underwriting, they're used for pricing, they're used for pooling, they're used by the mortgage insurance, they're used by investors. And so making sure that people have data so that they can calibrate the old to the new is going to be very important. And it's going to take lots of stakeholders, analyzing the data and making sure that their systems can absorb and that can process in a way that is safe and sound, and that we don't lose a beat in terms of risk management.
I appreciate that. No, and that's good. I hope that we can expedite that process, because I think we all recognize this is something that we want to get to in a safe way, but not something that takes years and years to do, but addresses the current concern. As both my colleagues on each side of the aisle have mentioned, my second announcement is moving to a buy-merge system. It raises some questions, though. My small community banks and credit unions, including those in rural Iowa, often only report data to one credit reporting agency. Under the buy-merger standard, two consumers who have similar credit profiles could potentially get different priced mortgages depending on, one, which two reports are pulled, two, which mortgage lender and consumers choose, and three, which or how many mortgage lenders they have access depending on where they live. So, for an example, one of my constituents living in a large metropolitan area like Des Moines might receive something very different from one of my rural guys in Bedford, Iowa. How's the FHFA going to ensure that all Americans have equal access to mortgages regardless of where they live and how they apply?
So we're working on that process right now, and we're getting input from stakeholders. We believe, after analysis, that moving from 3 credit scores to 2 is going to be beneficial for the borrowers. It will encourage competition from the credit reporting agencies, and it would lower costs for the borrowers, because instead of pulling in 3 credit reports, they only pull 2, and then the lender picks which 2 those are. Right now, we're working through the process with the GSEs on trying to figure out whether or not there is going to be the median or the average. So it used to be the median for the 3 and should it be the median for the two or the average for the two? And we have a request out for comment on that very issue of moving from bi-merge to tri-merge.
So as you look at that comment, I think one of the things that has a concern here is that you're asking for, the FHFA is asking for more data specifically related to those mortgage, but at the same time excluding some information from the mortgage process. So I hope that that provides some clear guidance. In my last 30 seconds here, I want to highlight the fact that we just had a cyber attack in Des Moines, Iowa. It really went after a number of young people who had no credit score whatsoever. That information is now being used by cyber criminals to be able to apply. Talk to us a little about what the FHFA is doing in this area to really protect first-time home buyers who may have no credit history.
So to the extent that first-time home buyers have no credit history, if they're renting and not living with their parents, perhaps the positive rental payments are being captured. But in cyber, there's not much.
Thank you, Mr. Chair. We'll submit those questions to the record, and I yield my time back.
Now recognize the gentlewoman from Texas, Ms. Dela Cruz, for 5 minutes.
Thank you, Chairman, for holding this important hearing today, and thank you, Director Thompson, for appearing before the committee. We're towards the end here. I will start here that I am concerned about the increasing prices of housing and the availability of affordable options, especially in my community, which is one of the most Hispanic districts in the entire nation. In fact, over 80% of our district is Hispanic. With that being said, record high inflation and a possible recession will only further complicate housing issues and introduce uncertainty in the system. We are living in a transitory period, moving from a low-rate environment to a high-rate environment. And it is a time when we should be most focused on the safety and soundness of our system and not pushing to remake the system. So with that said, Director Thompson, FHFA has required Fannie and Freddie to release equitable housing finance plans each year during your tenure. The stated purpose of these plans is to create, quote, goals and actions to advance equity in housing finance. That being said, equity can mean a lot of different things to a lot of different people. What does this mean to you specifically?
Sure, thank you for the question. So we believe equitable housing plans are the vehicle that allow us to identify barriers to home ownership for underserved communities and particularly minority communities, but also come up with goals and objectives to eliminate those barriers. And I'll give you an example. In the Latino community, one of the barriers are the documents for the mortgage itself. And as you mentioned, the mortgage is one of the largest asset that most people will have. And so what we've done is we've translated many of the mortgage documents into different languages so that people who don't have English as their first language can understand what the documents say and walk through the implication of this purchase. And so those are the barriers. So what's the goal to try to make the documents more understandable? So those are the types of things that are in the plan.
I reclaim my time. Now, this that you are talking about, you would agree, though, that your main responsibility is to focus on the safety and soundness of the system, correct?
Yes, everything we do is wrapped in safety and soundness.
And so our concern, of course, is that some of the trade-offs that you have had to make as a conservator and a regulator in the name of equity may be affecting that safety and soundness, not only for Hispanic communities, but for our district specifically. Let me ask you something. Do you believe that you have to move the goalposts? In other words, lessen or otherwise change the requirements to own a home to bring more borrowers to Fannie Mae and Freddie Mac?
We absolutely believe that we are not lowering any credit standards. We are not making any changes that borrowers who would not be eligible will be otherwise eligible. We're just not doing that. We've seen that before. The equitable plans really go towards, more education and also loan products and programs that are helpful to people who, again, have high credit or reasonable credit, but they don't have the down payment. If you look again at the enterprise's affordable programs, the average credit score for the borrowers in 2022 is over 700. In fact, it's over 730. And so we're talking about credit-worthy people. They may have low wealth, but they're credit-worthy and they pay their bills on time.
Well, and again, I believe that what we are feeling and what constituents are telling us is that they feel that they've worked hard for their higher credit score and that they're having penalties because, or having to pay higher because of that higher credit score. With that, I yield back.
I thank the gentlewoman from Texas. The gentleman from Tennessee, Mr. Ogles, is now recognized for 5 minutes.
Thank you, Mr. Chairman. And for the record, I do want to state, as it pertains to the potential of a default, the House Republicans have passed a piece of legislation. It is now incumbent upon the Senate Democrats to do their job and pass our bill, and is incumbent upon the President to do his job and sign our bill. So this notion that the Republicans are to blame is nonsense. If there's a default, it is a Democrat default. Ma'am, thank you for being here. I know it's been a long day, and you're ready to get out of here, as are we. But one of the things I want to discuss is how climate change and some of the climate activism is creeping into the regulatory regime. And I'll specifically go to Fannie Mae's website under ESG Environmental webpage. It notes, and I'll paraphrase here, that Fannie continually seeks to better understand climate change related to risk. Ms. Thompson, can you explain what risks to the banking, to the loans that climate has that's being articulated by Fannie and ultimately that you're overseeing?
Sure. So in the mortgage space, both Fannie and Freddie and the home loan banks look at natural disasters. I mean, we're in the mortgage housing business, and so to the extent that there are climate events, and there have been just an increased number in the past few years, whether it's flood or hurricanes or wind, they cause damage to the properties that are owned by the enterprises, and we want to make sure that...
I'll reclaim my time. So you're on the lending side, and the market has insurance for the purpose of risk, right? And so I would ask, in specific numerical terms as it pertains to climate change, if there's a 3.5 degree change in temperature, how does that affect the housing financial system?
Sure, I'm glad you raised the question, because in many states that are hugely impacted by climate, the insurance question remains. I know last year in one particular state, the rating for those insurance companies was going to be downgraded, and so that means that borrowers wouldn't have coverage.
Yes, ma'am, and I'll reclaim my time. So I'm a country boy from Tennessee, and flood insurance in Florida does not impact the borrowers in my state or the cornfields of Iowa. And so to have a regulatory regime that is enforcing or forcing climate regulations or those types of things into this system is quite frankly inappropriate, when what I would really want to know is, I look at going forward in the GSEs, what is the plan and timeline to get them out of conservatorship? Because we've had 2 administrations that have been talking about it. Everybody seems to agree that it needs to be done, but yet here we are continuing to have this conversation. Here we are without a clear picture of what the GSEs look like post conservatorship. How does it impact the free market? So I want to get back to the question of, what is your specific plan under your tenure to move them out of conservatorship quickly?
Right. So my plan is to make sure they continue to build capital and that the prices they charge cover the cost of capital for every loan that they take. Also, to make sure that they're running their operations in a safe and sound manner, and to make sure that they're protected, which goes back to the insurance issue you raised. It's not just flood, it's wind, hazard, fire. We need to make sure our properties are protected and that coverage is available for those properties at inception and through the life of the loan.
Yes, ma'am. But specifically, as you look at building capital based off of historic trends, and obviously we're in a different fluctuating market, what is your projected timeline to see them out of conservatorship? And is there anything that can be done to expedite that, such as private capital?
So we're working to, again, build capital for the enterprises. And because the market has shifted from record acquisitions for refinances to this purchase market, we're in the high interest rate, we've seen the number of loans coming to the enterprises decline. And so we're trying to build as much capital as we can and make sure their infrastructures are as safe and as sound as possible. It will take a long time to get to the capital requirements.
Yes, ma'am. So in other words, there's really not a specific timeline. We're kind of in the same conversation that we're going to be having this for a number of years. Mr. Chairman, I yield back.
Gentleman yields back. I want to thank Director Thompson for her testimony today. Without objection, all members have 5 legislative days within which to submit additional written questions for the witness to the chair, which will be forwarded to the witness for her response. You had lots of written questions today, and I ask you, Director Thompson, to please respond promptly as you are able. And I thank the ranking member for her perseverance in the hearing. This hearing is adjourned.